Welcome to the 2023-2024 Gordon Spellman Fund Student Presentations. I'm Charlie, and joining me are Maya, Macy, Noah, and Joey. All right, so to start, we'll be discussing the overall portfolio return, sharing the best and worst performers, going over the sector weights and returns, discussing the performance effects, sharing our recommendations, and then finally we'll hand it off to the students for their class presentations. Before I get into the overall portfolio return, we feel that it's important to note that all returns were only based on equity holdings, as well as that all of our data was recorded from April 14th, 2023 to April 15th, 2023. Going up to the fund value, we can see that the fund value is $455,162.47, and then the cash value is $53,102.65. And then going to the table, we can see that the Spellman Fund's 12-month return was roughly 20.66%, and the S&P 500's was 24.32%, putting the Spellman Fund roughly 4% under the benchmark performance. Going on to the year-to-date return, the Spellman Fund's was 4.14%, and the S&P was 6.58%. And finally, we can see that from both of the funds' returns, that the Spellman Fund underperformed, and that our beta here is saying that they're the same, which means that I just learned beta like the other day, by the way. So they share the same volatility and risk. However, we're underperforming, so that means that doesn't really work out that well. And then now I'll pass it over to Maya, who will be sharing the fund's worst and best performers. Thank you.
Okay, so starting with our three best performers, at the top we had Meta, who had about 126% return. And not only were they the highest returner in our fund, they were also one of the highest returners in the S&P. And this is mainly because they just launched a new social media app called Threads, which had over 1 million downloads within the first day of them launching it. Additionally, they just came out with new subscriptions for their virtual reality headsets. And then next we have Applied Materials, who had about an 84% return, and they actually beat Wall Street expectations for revenue and earnings. And additionally, they have a bright future because they will really benefit from chips powering artificial intelligence. Next, we have Netflix, who had about a 79% return, and this is actually their highest return to date, mainly because they've been cracking down on their password sharing policies, and that's been causing more households to purchase more of their subscriptions. Additionally, with those increase in purchasing subscriptions, they've been strategically increasing their prices for those plans. And then next, we have our three worst performers of the fund. To start, Pfizer was our worst performing stock in the fund with about a negative 34% return. This is mainly because COVID is less and less prominent now, so it's been costing Pfizer billions in net losses. Next, we have NextEra Energy, who had about a negative 17% return. And this is mainly because the economy's high interest rates have been making their long-term contracts more expensive compared to some of their competitors who have short-term contracts, which are less expensive right now with the high interest rates. And finally, we have PayPal, who also had a negative 17% return. And this is mainly because they haven't been able to bounce back from the online shopping surges during COVID. And additionally, one of their top competitors is Apple Pay, who have been outperforming them by a lot recently. Next, Macy is going to talk about our sector returns and weights.
So starting with the sector weights in the fund compared to the sector weights in the S&P 500, we can see that most of these sector weights in the fund fell within a few percentage points of the weights within the S&P 500, except for two sectors, communication services and consumer discretionary. So first, looking at communication services, we can see that the fund holds significantly more in this sector than the S&P 500 at 15.32% versus the S&P 500's 9.3%. Now looking at consumer discretionary, the fund holds significantly less in this sector at 4.72% versus the S&P 500's 10.28%. So now looking at the sector returns within the fund versus the sector returns in the S&P 500, we can again see that most of these sectors returns fall within a few percentage points of the returns in the S&P 500 as well, except for three sectors: real estate, healthcare, and utilities. First, looking at real estate, we can see that there was a negative 10.83% return within the fund and a 4.19% return in the S&P 500. Now, the reason for such a low return within the fund is because the fund is currently only invested in one real estate stock, and that is American Tower Corporation, and they did have a negative return over these last 12 months. Now looking at healthcare, healthcare had a negative 11.48% return in the fund and a 4.8% return in the S&P 500. Now looking at all of the healthcare stocks that we hold within the fund, they all performed very poorly over these last 12 months, especially Pfizer and United Health. These were the two worst performing healthcare stocks that we held within the fund, and they're what's really bringing down that overall return for that sector. But overall, looking at the healthcare stocks that we had in the fund, they all did perform pretty negatively, and this is why we are not seeing this sector performing where we'd like it to be. Lastly, looking at utilities, utilities was the worst performing sector in both the fund and the S&P 500. We had a negative 17.07% return within the fund and a negative 4.34% return in the S&P 500. Now, the reason for such a negative return in the fund is again because we are currently only invested in one utility stock, and that is NextEra Energy, and they had a negative return as well. But looking at the S&P 500's return, which again is negative, and this is because most of the utilities sector did perform negatively. However, Constellation Energy and NRG Energy actually performed extremely well, both having returns of over 100%. And so this is what we can see is kind of bringing up that S&P 500 return. Without those two companies, it'd be much more negative and probably closer to the return that we are seeing within the fund. Now looking at selection effect, just kind of reiterating what I was just talking about, but including those weights in there, we can again see that healthcare is severely underperforming compared to the S&P 500, as well as the utilities and real estate sectors. But then we can also see that information technology is also underperforming compared to the S&P 500 as well. So now that I've talked about some of the sector breakdown of the fund, I'm going to pass it off to Noah, who's going to talk about some more of the performance effects and some recommendations for you guys.
Thank you. So this graph shows the allocation effect, and the key sectors to look at here are communication services and information technology. So up top, communication services get that large positive number because we were actually overweight, and we also outperformed the S&P 500. And for that information technology, we were underweight, and then we also underperformed. So then we got total effect. Key sectors here are communication services, information technology, and healthcare. So for communication services, formed one of the best sectors here, just that positive number. And for information technology and healthcare, we performed worse than the benchmark returns. So then moving on to our sector recommendations. So first off, we want to trim our communication service holdings. So we actually had to do this last year, and now we have to do it again because of Meta and Netflix's success. So we're currently looking at a 15.32 sector weight compared to the S&P 500's 9.3. So we just want to continue trimming that to get to a target weight of around 13%. And then next is increased consumer discretionary weight. So you can see there, 4.72 is our current weight, and the S&P 500 is at 10.28. So we're considerably lower than the S&P 500. We just want to increase our holdings or buy some new stocks to get to a target weight of around 9 to 10%. And then lastly is invest in the technology sector. So our current sector weight is at 27.83. The S&P is at 29.66. We're looking to increase that to get to a target weight of around 32 to 33%. Joey will talk about why we believe investing in the technology sector, as well as some of the student presentations that fall in line with our sector recommendations.
All right, so as Noah said, we believe that the technology industry will continue to performing well. We believe this because of artificial intelligence. As you guys all know, artificial intelligence has begun to take over. It has been being incorporated in businesses. A little bit of research we did from Accenture's research. Many companies that are incorporating AI within their businesses are projected twice the market share and 10 times more efficiency than their competitors in 2024. And looking at a longer run back in the future in 2035, businesses that use AI are expected to double in efficiency of the workforce and boost profitability by an average of 38%. Also with this, two of our stock presentations that will be following this are Nvidia and ARM Holdings, who are gonna be recommending adding to the technology sector. So we believe that their presentations will further evident why we should be adding these stocks. And as Noah said about consumer discretionary, this part of our sector is a little bit lower than the S&P 500, and two presentations, Home Depot and Amazon, are also going to be presented, and we believe that they'll give evidence why we should be adding these stocks to increase that sector weight. And then, I mean, we'd like to thank you guys for your time. If you have any questions now, feel free to ask me.
Can I start? You guys go with it?
You asking me?
Yeah, well, I mean, usually you butt in.
First 2 minutes.
Okay, sorry, first overall, I thought it was a really nice job. You guys, what I liked is you guys don't read off the slides, like you actually know what you're talking about and your confidence projects well, so kudos to y'all. Can you go back to the fun presentations? So go back to the stocks actually. So just out of curiosity, you know, you talked about the consumer discretionary and the technology. So you're kind of pitching us on that before these guys even get in. Was there any kind of premeditated discussion on different areas that the students that are presenting, the kind of ideas and direction that they should go? Because it kind of nicely aligns with what you're saying, or did you guys have a totally separated process to come up with this?
It was separate.
Parker,
So yeah.
said he looked at it and he saw that consumer discretionary was low. He did mention that to me like just now.
So Parker, who's pitching Home Depot.
Yes.
So was there any kind of?
It wasn't like, we didn't like work together on that, but
No.
it just happened to like align, I guess,
We
so.
just separately analyzed it
Yeah.
and that's what we came out with and it just
It
happened to
kind of
add
ended
some
up
of them.
aligning nicely with
Yeah,
our
yeah.
recommendations, and then seeing that two of the presentations for consumer discretionary and two from technology, so it kind of.
I was just curious, because it just happened to be.
Yeah, we.
Coincidence, maybe, maybe not.
Any other questions?
Help me understand a little bit. You're not exactly on the index as far as your distribution to different industry. What comes first? Do you pick a company first, or do you pick an allocation? Help me understand what the thinking of the fund is, so I can understand when I'm looking at a company. Is this a play for technology, or is this specifically to the company, or some combination which dominates the other?
I guess like overall diversification is obviously really good. So our goal is to be sort of in line with the S&P 500. We also like want to outperform. So just like buying into consumer discretionary would just help us diversify because we're obviously lower right now. But as well as like real estate and utilities, we are low in that, but there aren't any student presentations talking about that one. So in the future, it might be a good idea to diversify in those, but as of now, I think just diversification is always good.
I think the goal will be eventually that this team passes along recommendations to the next semester's group of students just and say, hey, we need more of this or less of this. So, but for now, with sort of getting this up and running again, that, you know, sort of just analyze our current holdings, and the students presenting today were separate from this group's thinking and process.
Okay, fair enough.
And then just one quick suggestion to think about. So you guys do a great job of showing what we own and how that affected us. Back when I had a job doing this, a lot of times I would tell clients, it is what you own, but sometimes it's also what you don't own. So when you might want to think about what are the top, we'll call it 5 contributors to the index that maybe we didn't own, that plus or minus can help differentiate, you know, our performance. Because I mean, Lilly was one in healthcare, I'm sure. You know, best performing probably drug stock. Then I guess I forgot that we had Nvidia, but I was trying to think like what else that we didn't own in the fund that would have maybe, especially in a crazy year last year, I just kept, when I first saw the returns, the first thing I thought in my mind was the Mag 7.
Yeah.
And we probably just got blown away by the Mag 7, but the portfolio is probably okay X that. So sometimes again, it's just helpful to know what you don't know.
Good afternoon, everybody. Thank you for joining us. Today, we're going to be talking about how Fastenal fits into the Spellman Fund. We are recommending a buy of 216 shares at the current price of $68.09, which was yesterday's closing price. My name is Kenz, and I'm joined here with Clara, Max, and Brady. So to start off, today we're going to talk about the business overview of Fastenal and their different revenue streams. We're going to go into their risks and what actions they're taking to mitigate these risks, while going over their financials and comparing that to both their competitors and the industry average. We're gonna talk about two different growth drivers today, on-sites and e-commerce, before going over our valuation, both pessimistic and optimistic, how the Fastenal stock fits in with the Spellman Fund, before concluding with our recommendation. So to start off, Fastenal is a global distributor of industrial supplies as well as supply chain management, which is their FMI program, so Fastenal's managed inventory. If you can see on the pie chart on my left, the revenue breakdown includes fasteners as their most heavily revenue sourced category, followed by safety supplies, with the other being 8 smaller categories, which ranges from janitorial supplies to other tools. Fastenal is a global competitor in the industrial market, where most of their sales comes from North America sector, with their primary revenue coming from the United States. Looking at their market share, Fastenal's market share currently in the industrials materials is 3%, which is 0.2% higher than it was last quarter. One thing to note about the market share is after our meeting with the CFO, Golden Lewis, he noted to us that since Fastenal has such a wide range of products and services, they can be listed in multiple different market sectors, with one of their largest market shares being around 10% of the fastener category. Some recent news of Fastenal, they recently had their earnings call where they noted that they missed their EPS projection by 1 penny, which caused a fall in the stock price. However, we do not find that concerning at this time because Dan Johnson, a board member of Fastenal, did take advantage of this and purchased around 3,000 shares of Fastenal. Looking at an overview of the Fastenal ticker, we are recommending a purchase of 216 shares of Fastenal at the current price of $68. And we are recommending a sell of the Union Pacific around 62 shares to maintain the weight in the industrial sector for the Spellman Fund. The target price we have concluded to is around $74, with at the current price makes the target return around a little bit over 10%. Looking at Fastenal's business, they have a concentration in the fasteners category, which is hence the name Fastenal, which is makes them vulnerable to the demand fluctuations in the supply chain. Additionally, they are an international company, which allows them for international expansion. Looking at the two key drivers, on-sites and e-commerce. On-sites is one of their market location revenue sources, whereas e-commerce is one of their product market revenue sources. And we'll get into the different revenue streams in a little bit. Looking at the risks, two of Fastenal's major risks include their market dependency risk, because they're a supply chain and they have many different distribution centers, as well as the supply chain distribution. Taking a quick overview of the stock price and the recent stock price history, you can see here that since Fastenal's IPO, it has significantly grew and is continuing to grow, and it is a very steady stock.
So getting into a business overview for Fastenal. So the company revenue streams include product distribution, consulting services, logistics management, and technology services. We have here our baseline scenario growth rates for our two growth drivers, earnings, or on-sites and e-commerce, as well as other earnings. We have those for 2024 through 2028, as well as that post-2028 terminal growth rate. And then we also have our 2023 sales breakdown. So Fastenal's revenue is broken down in sort of two ways or filters. So first, it's broken down by market selling location. So where is it sold out of? That's going to be the on-sites, the branches, and other. And then it's also broken down by sales channels. So how is it sold? So that's e-commerce, FMI, and other. And then FMI does include that fast bin, fast stock, the vending machines. And then continuing on the revenue stream. So to talk a bit about what an on-site is. So an on-site is a retail sales location that is placed at the location of the customer. So at their warehouse or wherever they're operating. This eliminates the need for the customer to travel to the store to get the product, or it eliminates the need for them to wait for shipping. And then here we just have our 2023 and 2022 sales breakdowns for those market selling locations. So going over Fastenal's ESG. So this information was pulled from Fastenal's most recent ESG report. A couple of pros we pulled from the report. First one being environmental. So they are reducing over 600,000 pounds of plastic waste from their operations. ESG is regularly discussed at board meetings, and they do have a corporate team for ESG initiatives. Also, Fastenal is ranked really highly in workplace safety. They are 51% above the industry average for that metric. A couple cons we pulled from that report. First one is women are underrepresented in Fastenal's workforce, which is pretty consistent with the industry that they operate within. And then another one relating to that industry, manufacturing generally just does consume a lot of natural resources and it produces a lot of waste and emissions. That being said, Fastenal is expected to further strengthen their ESG commitment, likely by enhancing transparency and impact assessment. Overall, the company would likely be rated favorably for ESG efforts. Getting into some risks here. So we have main risks that Fastenal faces. We have them ranked on a risk matrix with significance and probability. One of their biggest risks that they face is supply chain disruptions. So that's ranked medium with both metrics. This is a big one because of Fastenal's, they do a lot of business with supply chains and distributing of products. They do have a lot of risk management procedures in place to mitigate supply chain risk. So for every product or group of products, Fastenal has multiple suppliers, usually in different countries, so that if a supply chain disruption happens or if something happens with a supplier, they have other suppliers that they can go to source that product. Getting into some financials here. So we have major financial ratios for Fastenal from 2021 through 2023, as well as that trailing 12-month as of most recent quarter end. And we also have the ratios for Genuine Parts and Grainger, which is Fastenal's top two competitors, as well as the industry average. A couple things we just wanted to make sure to note with this slide. Fastenal's ROE, ROA, and net profit margin are higher than the industry average, and their debt to equity ratio is considerably lower than both of their top competitors as well as the industry average. Continuing with financials, so total debt for Fastenal is around 4% of revenue. 2023 short-term debt was 60 million and long-term was 260 million. And then the weighted average cost of outstanding debt at the end of 2023 was around 7%.
Now getting into our first growth driver, on-sites. Fastenal believes they have 12,000 potential customer locations in North America. Despite missing their mark of 375 to 400 potential on-site locations, they still believe they have ample room to grow in the on-site service department. On-site services represented roughly 40% of their net sales in 2023, and the revenue growth for on-sites could substantially increase their revenue due to its significant contribution to overall sales. Now looking in the past. So in 2024, we're projecting roughly 356 additional on-sites. And something I'd like to note here, for on-site locations and on-site revenue and revenue per on-site location, it has steadily increased since 2023 through 2020. And in 2024, we're looking at about 2,100 new on-site locations, and on-site revenue is going to be a little under $4 billion. And then revenue per on-site location, we're looking at about $1.8 million. Now looking in the future, so the terminal growth rates we're projecting is for optimistic is going to be 5%, baseline 4%, and for pessimistic 3%. And for optimistic, we are projecting additional 388 on-sites, and for pessimistic, we're looking at about 274. And something to note here is through 2024 through 2028, we're going to slowly see a taper on their revenue growth rates. Now diving into our second growth driver, e-commerce. So e-commerce is going to drive global online transactions and it's evolving customer behaviors. With tech advancements, it's becoming more widely capable for customers that use e-commerce platforms. In addition, since COVID-19, we've seen a surge of the e-commerce platform. And a percentage of our total sales, e-commerce accounted for roughly 25% of total sales. In the quarterly growth, e-commerce sales grew by roughly 30% in quarter 4 of 2023. So some key assumptions to note here. Fastenal's growth will follow the industries it works within. Fastenal's e-commerce will continue to grow at these current rates. And on to my left here, the projected construction materials, industrial products and services, and business e-commerce are noted based off the average year-over-year industry growth rates. And then looking into the future, we're still going to use those same terminal growth rates of 5%, 4%, and 3%. And then for optimistic in 2024, we're looking at about 31%, the baseline to be 28%, and then pessimistic to be a little under 24%, and those will slowly go down as well.
All right, getting into our valuation here, the first thing that we did is we broke it down into our on-sites, e-commerce, and then other EPS. The biggest thing to note here, on-sites is roughly 40% of that EPS, e-commerce is 14%. We touched on earlier how it's 25% of sales, but there is some overlap. So we figured out what that overlap was and cut back our e-commerce to accurately measure that. Biggest takeaway on this slide is that we're projecting from around $2.02 to $3.67 by 2027. Our next figure here, so this is that scenario analysis we were talking about. We have our optimistic and pessimistic scenarios. And the baseline goes to 393 because we projected one more year out here. With our optimistic, it is roughly going to double, a little more than double. They have done that a couple times in the past in that time frame, so it's not too ambitious, but it's definitely ambitious based on the current economic conditions. And then pessimistic, 202 to 368. All right, and this is just our overall valuation, how we came to our target price here. First thing was that PE ratio. What we did for the PE ratio, so our baseline is an average from 1999 to 2023 from Fastenal's PE ratios, and that came in around 30.53. And that was something that is relatively consistent to where they're at. It's actually a little lower than where they're at right now. And then we did some statistics to find that 1 year ahead PE ratio for optimistic and pessimistic. We do have those calculations in an appendix if you'd like to see more of those later. Baseline target price for 1 year ahead for PE was $88. Dropping down to our discounted cash flows here, we have our optimistic, pessimistic, and baseline again. Our baseline came in around $60 for the average from firm and equity, and then 75 and 49 for the other two. As for the overall target, we combined it 50-50 on our PE and discounted cash flows. Our baseline target price coming in at that 73.96 that you've seen a couple times previously, and then 87 for the optimistic and 62.64 for our pessimistic. Just the overall portfolio fit of Fastenal in the fund, we're looking at the highest correlation being the fund overall. The Spellman fund is already overweight in the industrial sector, so we're not really looking to increase the weight, as UNP is also an industrials stock. And because of that, we think that cutting the UNP in half and using the other half to buy Fastenal will significantly reduce just the overall correlation of those two in the fund. And then our recommendation broken down into before and after here. So again, our purchase recommendation is 216 shares at that $68, and then selling 62 shares. UNP's close price yesterday was $238. Those are the market values that we would sell, and then at the end of our trade, they would roughly both be 3.2% of the fund. Overall summary here, we have our recommendation, 216 shares at the current price, and that is, again, just maintaining that 10% weight in the sector. Some of our biggest takeaways we'd like you guys to have is just the different diversified revenue streams based on both the markets and the channels. And then the two biggest growth opportunities we talked about were those on-sites and e-commerce. And then lastly, looking at just the financial information of the company. They're a very mature company. They have been consistently giving back to their shareholders through dividends quarterly. So with that, does anyone have any questions?
I will go first. I'll let you guys have this. You'll probably ask the question I'm gonna ask.
No, I've got questions, but I want to see if anybody else has the same questions.
Go ahead, guys. I'll start, and ladies. Not here, sorry. Just a comment first. I thought you all did a really good job in the presentation, spoke very clearly. Clearly understood what your topic was, so I appreciate that. I want to go to I guess before I go to a slide, you had a lot of tables in there with a lot of numbers. It was hard for us to follow that when they were on the screen. When you're talking, we're trying to listen to you, we're trying to look on the screen, and then before we know it, we're on the next slide. So I know we have a restricted amount of time, but that was hard to follow. So that'd be kind of a comment on in presentations. If you got a lot of information on the slide, make sure to direct us to what you really want us to focus on, or at least spend some time to explain it. On that note, could you go through the financial ratio slide, please? Yep, that one. So if I look at the PE, either trailing 12 months or historically relative to peers in the industry, it looks like it's at a premium. Why do you think Fastenal deserves a premium PE relative to its peers?
Well, I guess, so we met with Fastenal CEO and CFO, and we asked them that question, and his answer was basically because they deserve it based on where they've they deserve it based on their returns and what they do for their customers as well as their shareholders throughout the industry. They think that the loyalty that they bring to the customer commends the higher PE ratio for their price in terms of the industry.
I think that's important to have that kind of key connection with your customers. You know, the one thing that stood out for me is looking at, and this was mentioned in the presentation, the ROE, ROA, those are measurements of quality of business. Those appear to be higher than most peers. So certainly in the current market environment, investors are paying up for quality. So I think that helps to justify. I don't know historically if they've always had that quality bent to it. But that'd be one thing that stood out to me, in addition to maybe what you mentioned. But it's unsure to fully quantify, is that premium justified in their quality and some of their other metrics. But I'll stop there, see if others have questions.
Go ahead, Bob. You got nothing? Could you go to your growth rate slide 18? Okay. So this is overall growth rate. We're looking at baseline 28%, 21%, 16, 13. What has it been over the last, say, 5 to 10 years? What's the growth rate been?
Well, so this is just for e-commerce. And
Just
they,
e-commerce. Okay, I'm sorry.
Yes.
so it's a little bit different because they, like I said, they report kind of funky. They report by channels and then by method as well. And they haven't really taken on e-commerce to the extent of, now they're working with Microsoft, they're doing AI stuff to get that better. But they just started reporting it maybe 2-3 years ago in terms of like an actual percentage. So we do have an appendix slide on how we came up.
Or did you wanna
Do
see
you
the?
have can I jump in? I have the exact same question. Do you have like their total, like, as a company, the total growth rate?
Yes.
Okay,
So we took both what the industry is expected to grow at as well as what they have done, Fastenal has done historically, and we combined those together. It says e-commerce.
Oh, go back to that one. So like, I mean, this is EPS instead of revenue, same ballpark. But like our largest increase throughout all of our calculations was this year to next year, and that's at 21%. And they're almost 30% in 17 to 18, and then 17 from 21 to 22. And just on a side note with that, so obviously they have the branches and the on-sites. Over the last 10 years, they've closed 40% of their branches. So, and they're officially done closing branches, so now all their resources are away from potentially closing some, and it's all focused towards growing the on-sites. So that's where we think that is a justifiable growth rate despite, interest rates, economy, things that we're at.
So when you have your forward-looking growth rates, what was our assumed after the 21% or 22%? What does it look like after that?
It was back in our, yeah,
First slides, I think you guys said.
So.
12, this is it, okay. Okay.
And this like lower growth for e-commerce also accounts for the overlap between on-site growth and e-commerce growth. So to make sure that we aren't double growing e-commerce, we went back.
And if we go out 5 years, is the expectation at that point we'll have 0 branches and everything will be on site? Is that where we're seeing the?
No,
They stopped.
so like their branches, like they, like say like Rochester has 2, they would just make it only be 1. And like they're still like within 95% of the manufacturing base that was before, but since all the closings, now they're still within like 93.5% of the manufacturing base in the United States. So it's more just like cost saving method, and they're gonna start focusing more on the on-sites, but yeah, they did tell us they're done closing branches.
So they've closed them, they're done now. They're gonna focus on the ones they have and expand the on-site.
You're going, I think you're getting where I'm going, maybe.
No, you go, cause
Okay.
I'm gonna change gears completely if you.
Okay, so this is a good transition. So as I'm thinking about this, you have stores that I can go in and get my fasteners. Now I have a store on site in my widget factory. How did you guys think of, and it took me half your presentation to remember this word, cannibalize? Because, yeah, see, yeah. So basically what you're doing is you're taking sales from this bucket, you're just putting it in this bucket. It's just, it's on site, right?
That is
So
why.
how is your earnings, like if you got earnings here and they're $1 million, but now I'm putting them on site and based off of all the on sites, I have 5 on sites that had the same volume that you had in your one office or whatever you call it, location. Does your growth actually improve as you transition, right? Cause you're still serving this potentially the same customers, I would think, right? So you just kind of, instead of, it'd be like having a 3D printer in your house, instead of having to go to Home Depot to buy it, I have it in my house, but I'm still buying the same stuff.
Yeah.
So how much, I'm trying to figure out what's the growth ramp between the bucket being here versus on site.
I think part of the reasoning is to get the product to the customer even faster and be able to manage, because Fastenal will manage the inventory at the onsite, so the customer doesn't even have to think about what do I need.
Yeah.
Fastenal will manage it for them, so
I understand that piece of it, but I'm just saying, do you have incremental growth because of the on-site over having to go to the store?
So bad graph because it's the opposite of what's actually happening. There's only 2 instances in the last 10 years where branch revenue has actually gone down. So here, like in 2022, it was, 4.1 and then less than that. But even though they've closed 40% of their branches, they've still been growing that revenues. But we don't, because that revenue is still growing and the onsite revenue is growing, we don't think it's necessarily eating each other.
Okay, I mean, I think you know what I'm trying to say.
Yeah,
I'm trying to get,
I get the taking away, it's all the same.
yeah, it's all the same, but then is it growing on top of that because of what they're doing?
yes.
Parasites, the first one. That's not it. It's not parasite, it's something else. Cannibals.
Page 10. Just, so when you showed me the growth rates, it looked like there was some fairly significant swings, 6.3, 17.4, 21, 4. How sensitive are they to economic downturns? Cause it feels to me like maybe that's the more significant risk as opposed to. They're buying product from China, I'm assuming?
Yeah.
China,
Taiwan.
Taiwan.
Um, and then obviously sensitive, because you look at some of those past years, there weren't necessarily supply chain disruptions, but you saw significant fluctuations from year to year in terms of revenues. And that's more of an observation. I may have shuffled that around in the matrix.
Not sure what they're trying to find at the moment, but regardless, I think one of their things is that they're very diversified. So like even when now it's kind of a weird example because it benefited them greatly, but like when COVID hit, they have fasteners, but they also have safety supplies and safety supplies skyrocketed. So that kind of,
Surpass.
well, it leveled out the playing field in terms of they have areas where when the economy's down, that potentially can take more of the fastener role. So they are still impacted by it, but I think it's lessened because of their diversified buckets, just because even in that other one, I mean, you're looking at it's 46% of the business and there's still 8 other things in there. Not that they're huge things, but I think that helps weather the storm. Now, should have been higher on the matrix probably, if, that's where we're at with that.
We do have their historic sales and earnings per share, just in case this came up, so like, you can see through the recessions, like they didn't hit in 08, but they ended up coming back, and then like 2020, they didn't even really go down with that one.
That's the safety supplies.
Yeah.
Yes, yeah.
I was just having
No,
a draft.
that's perfect.
Before I'm done though. How cool was it that on the front page, you got a picture of the CFO and CEO?
Yeah, that's cool.
I mean, granted, they're local, but I still.
No, we were incredibly.
Really appreciate.
We were, yeah, very excited.
Kudos to you guys for reaching out to company leadership. I don't think we've seen that before.
We also met with one of their current board members, Dan Johnson, who we mentioned bought those shares, and we talked to him about expected growth in the construction industry and like
to help us get an idea of our growth rates. So that was also a great source that we used.
Else? I got a question. You talked about, I think on one slide you had revenue per site. So you're growing, it seemed like they're growing revenue per site. Are they growing expenses equally or are their margins expanding throughout that?
I don't know if we have a table.
We don't have a table on
For
it,
that,
so
but-
the good part about the on-sites is that, I mean, it only takes 1 to 2 people. Yeah, obviously, so their margins are incredibly high on that because they're not paying for the space. I mean, they're getting paid to be in the space basically, and then they only have 1 to 2 people there, so I mean, it really should, I don't think it's increasing, but I think it's a pretty consistent high net
So
profit.
it's higher margin than the branches, so
branches,
does
yeah.
that help address the risk of cannibalization if they're earning higher margins?
I would think so. Yeah, it costs less to run it on site than it does to run a branch.
But you don't have margin data to kind of confirm that theory.
Unfortunately. Would have been a great thing.
Yeah, that would have been.
Got one comment about the recommendations, so we've got Fastenal projected about a 10% return. And then I know you guys aren't responsible for covering Union Pacific. But just think of like strategy wise, when you talk about investing money. You know, what was the thought process on selling the shares of Union Pacific? Is it because we feel like there's no potential return with Union Pacific, or just, you know, some of the decision we're gonna have to make, obviously, is like if we got a investment over here that we're projecting 10% return, but we're selling company Y, which is Union Pacific, are we selling that because we don't feel like there's any growth there, or could Union Pacific outdo better than 10%? So why, you know, so just something to consider when you talk about a buy recommendation and then a sell at the same time, because we want to make sure if we're selling something that we're getting a better return on the buy side when we're looking at making that, you know, change. So I know your job wasn't to cover Union Pacific and to know what that valuation was, but if you have any comments on that, where you guys came from on that side of things, that'd be great.
Yeah, that's definitely a really great comment. I think our biggest like reason for choosing Union Pacific to sell half of and then replace with Fastenal was mostly diversification. Union Pacific has, I think, the 3rd largest holdings in the fund. And so even just based on the policy statement, I think the goal was like around under 5% for each stock. So with it being over and with it being in the same sector as Fastenal, we thought it would be a good candidate to just take some of it out, replace with Fastenal, get that more diversified. Just another pro of having Fastenal in from a diversification standpoint, it is gives us more exposure to mid caps as well, which the fund has none of.
Before and after.
So we have the current Spellman fund, and then with our proposed trade of half of Union Pacific gone and Fastenal added. So you can see changes here from the blend, and then you get a mid cap exposure there as well.
Mostly a technicality just on how much.
Okay, we only got a couple minutes left, so I'll give you some homework for cocktail hour. If you go all the way to the beginning of your presentation, we're just gonna talk about the market in general. I want you guys to think about debt. So you can stop, go back for 1 hot second, just so everyone can see it. So you talked about the debt, sorry,
Where we go?
yeah, right there. What next one over, sorry, the ratios page. So the debt to equity is at 16% versus all these much higher numbers. So that's an active decision from a management perspective. We're not gonna take on a lot of debt. So my question to you for cocktail hour is, why is that? And should that change? Based on, now if you flip all the way to the beginning of the page, or the beginning of the deck, go to like you first discuss the business overview, next one, your market share is 3%. Industry is 2.6 or 261 billion versus 7.2. So you have not a lot of debt in a very fragmented industry. So think about that from here until the next time I see you. Put on your manager hat. Where would a good idea to actually maybe put some debt on the board? First, why don't they have a lot of debt? Maybe ask them that. And where could you actually use debt to your advantage, given you're such a small piece in the market?
Growths.
And how would you do it?
We'll do our homework.
You got 12 hours.
Alright, well, good afternoon, guys. First off, we just wanna say thanks for coming and being with us. Before we start, we just wanna introduce ourselves. I'm Ben.
Kevin.
I'm James.
I'm Alex.
And today we'll be talking about arm holdings with the recommendation of a hold. So just some itinerary for the presentation. We'll go over the business overview, the revenue breakdown, the risks, then we'll move into the financials, key growth drivers, evaluation, into the portfolio fit, and then again, we'll wrap it up with a summary. So ARM business overview, what is ARM? ARM is a semiconductor and software design company out of England. They were formed in 1990. They just recently launched their IPO in 2023 in September, so about 8 months ago. ARM generates most of its revenue through the licensing of their products and the royalties that come from them. It's about 63% of the revenue. And one recommendation, we recommend a hold of ARM to the current state of this company. Just some more information that we're going to talk about. We see ARM as a company with a lot of growth potential, as an already solidified company in the semiconductor industry. We're recommending a hold this time with the lack of growth, we're able to be proven with the data that's available to us and the uncertainty of the future. Key growth drivers, well, 99% of smartphones have ARM-based CPUs. ARM expects to gain 50% of the cloud data market in the next 10 years. They currently only have 10%. And increase of demand from companies who want to license ARM products for cloud computing driven by AI. So here we'll move into the licensing model. This graphic kind of shows how this process works for ARM. Obviously, ARM makes the product, whether it's a CPU, IP, or microprocessor. And companies such as Apple, Google, Nvidia, or third-party companies, they want to acquire that product from ARM. So in return, they will get royalty and licensing fee, and they will be able to use ARM products for licensing models that we'll talk about next slide. And then they can put them into their products such as an Apple, MacBook, iPhone, or any kind of product that requires this kind of stuff. So here are the licensing agreements. ARM currently offers 4. First is the most inclusive and most expensive. It's also the least taken by people. So a total access agreement, it's all access to new and existing ARM products on a per unit royalty. This was first offered in 2021. Next, we have the flexible access agreement, which was offered in 2019. The only difference between the total and the flexible is that they only have access to existing ARM products. And this is also based on a per unit royalty. Next, we have the most common one, which is what most companies come to ARM for, is a technology licensing agreement. Just a single technology agreed for a fixed fee. This is obviously what most companies want, whether it's a single CPU, single IP. So they'll come to ARM for this. And then lastly, with the architecture licensing agreement, customers can develop their own highly customized CPU that is compliant with ARM's ISA. So that's the licensing agreements.
And going into kind of a summary of what we're doing here. So again, our recommendation is a hold. And we are looking to have another group research ARM again as it matures within the market. And again, we see it as a target price of about $82. Its current price is at $95. So that'd be about a 14% decrease from its current prices. So business, it's primarily operating in licensing technology. And that means they're going to be heavily involved in AI growth due to many companies needing their technology for energy efficient and a lot of calculations that come with AI. Key drivers, cloud computing, consumer electronics. As these areas grow, this means that ARM will grow as more companies need to license more of their products. Some big risks with their stock is that because it is so heavily involved in AI growth, if we are seeing an AI bubble currently, that means that if that pops, that could mean a huge decrease in the stock as people that were speculating on AI begin to sell. Another big risk is that 90% of the shares of ARM right now are owned by SoftBank. And that means that the public has access to about 10% of the total shares. So that can mean a lot of volatility because of the low liquidity in the stock itself. So again, looking into the stock chart here, you can see that in its IPO, it was about a little over $60. It peaked in around February at around like $150, and since then it's decreased to a little under $100, but it kind of ranges. As you can see there, the PE ratio, it's pretty high for what the stock is. In 23 is about 100, and now it's sitting around $83. So getting into the revenue overview. So as we discussed earlier, most of their revenue comes from royalties, with about 63% of their revenue. A big driver of their revenue growth is going to be the introduction of ARM v9. That is their most recent licensing architecture. And with that, they are going to see about 2 times the royalties from ARM v8. But right now, it is about only 15% of their total royalty revenue. So it is a little bit slow in adoption. And licensing is going to be about 38% of revenue. And that's, as you can see on the growth chart there, they had a big increase in revenue across the board in 22. But as we're seeing in 23, only the royalty revenue has positive growth, and the licensing and total revenue is a bit down in growth. So then going into the geographic revenue segments, the main kind of focus here is the China segment of ARM. You can see that in 2022 it was about 18%, and now it is about at 25%. And the big driver of that is because China is going to be sort of catching up with the global market in terms of AI and cloud computing. It's going to see more revenue because of that. Next, we'll get into the ESG segment of ARM. Big pros here is that it is 100%, they use 100% renewable energy as of 23. They also are aiming for a net zero carbon emissions by 2030. They also have initiatives of buying carbon credits and reducing their carbon emissions. Another big factor is their strategic partnerships with foundations such as UNICEF and the Gates Foundation. And they use those to provide a fair distribution and sustainable development of their technology. Some cons with the ESG, data centers and cloud computing are projected to have massive consumption of data. They're projected by 2026 to have a total of 1,000 terawatts of energy usage, which currently would be the entirety of Japan's usage. And another con is that it is a male-dominated company, with 2 of 9 female board members being present and about 20% of the entire company being female. That's also compared to about a 35% average in tech. And some other big things here is that they are a company that does focus on energy efficiency and performance within their chips, while also decreasing the price. They are also continuing initiatives to maximize, I already covered that. And through all this, we rate this company favorable based on ESG.
So now I'm going to talk about the risk matrix as well as risk facing ARM today as well as in the future. So as Kevin talked about, the AI bubble popping would be a big problem for our ARM, as they have lots of R&D, reinvestment research that actually goes into AI. And then the IPO over evaluation is also a concern for many companies, and a lot of IPOs have been struggling as of recently, so we don't really find this too concerning. And then ARM China and then the China tariffs kind of work together. So the China tariffs on China right now, limiting technology that we are able to currently sell to China, as well as ARM China, which is a subsidiary of ARM, and they currently have constantly have payables to ARM, which often they default on, and they constantly have ARM constantly has receivables from ARM China. And then fewer semiconductor companies as well is a concern, because that's their bread and butter is microprocessors and processors and CPUs. And then if you want to go on the next slide, the IPO over evaluation that I was talking about, some of the numbers that are related is the PE and the PEG. And we don't really find these too concerning because they, as I was saying, they have lots of reinvestment research and a lot of their money goes towards that. And then we noticed that the future growth PEG is a lot higher than the past growth PEG, which is actually on par with the industry average. And this is just because we don't think that the growth summary is exactly how we think it will be for ARM. Same with the price to book ratio as well. And then one thing I want to point out is net profit margin, which is 32.88%, which is higher than the industry averages, which we find is a good thing. Excuse me. And we think that the net profit margin will be around 40%, excluding one-time deals. And if you notice the debt to equity ratios, we don't have any for 2023 or the TTM. And that's because ARM basically has no debt. If you want to continue to the next slide. ARM's balance sheet consists of non-interest bearing liabilities and equity, no short-term interest bearing debt or liabilities. They have $866 million of tax liabilities, contracts, operating leases, share-based compensation, and et cetera. And then they have no long interest bearing liabilities either, but they have $1.25 billion of deferred tax, contract, opening lease, and share-based compensation values that they have as debt.
Perfect. So now we're gonna get into the growth drivers here. Our first growth driver is in consumer electronics. So we see that consumer electronics today directly contributes to around 65% of the total royalty revenue. And royalty revenue is the largest revenue structure for the company, so this is pretty big. 12% is coming from TVs, laptops, and wearables, and then the other 53% is coming from smartphones, which they dominate in right now. As you can see here, everybody's smartphone in this room is running on ARM processing IP. So the biggest thing is trying to expand into these new areas of tech such as laptops, VR, wearables, and more. They just had a recent deal with Apple. Their processing IP will be in all of MacBooks through 2040. And then they're also trying to scoop up market share in the laptop industry. They only have 15% market share right now from this deal with Apple, but they're also looking to move into running Windows on ARM. So that'll give them a larger part of the market share as well. And so for our baseline industry growth, we put it at around 8%. We got that projection just by taking some averages from the companies that I listed up there. On the pessimistic side of things, we have around a 4% industry growth rate. We don't see it dropping anywhere below that, but that's just gonna happen if we're unable to scoop up market share from Intel. Their x86 architecture right now, a lot of people are weaning off of that and moving towards ARM. So if we just can't scoop up market share from Intel, then we're gonna struggle there. Again, if there's an economic downturn, less consumer spending, it's gonna lead to less royalty growth overall. On the optimistic side of things, we had around 12%, and this is gonna be if we can continue to scoop up market share from Intel. And then we have a market share increase in consumer electronics overall. We're gonna think it's around 50% by 2029 with a compound annual growth rate of 9%. And the second main driver here is gonna be in cloud computing. Cloud computing right now is a huge issue across all of AI at the moment, just because of the energy inefficiency that's going on with it. So we're seeing a lot of companies that are starting to shift their processing IP to ARM so they can run their CPUs in a lot of these data centers. So we see companies like Amazon, Alibaba, Microsoft, Nvidia, and Google have all made the transition into ARM. And then we also talked to their investor relations vice president, Ian Thornton, and he told us that they are expected to have captured 50% of the cloud computing market within the next 10 years. And so for baseline growth here, we have around 15%, with the pessimistic side of things looking at around 11% industry growth. Again, if we are unable to scoop up market share from Intel and the inefficiencies that they're running on, and then if there's an economic downturn, less R&D expenses are going to be tailored towards the cloud computing sector. On the optimistic side of things, we have around 19% industry growth, and that's also just going to be if we can continue to scoop up market share from Intel. And so here again is just a couple of brief numbers from us. We have a compound annual growth rate of this sector growing at around 17.5% per year. And we expect that market share to reach 50% by 2034.
So as far as our valuation goes, we have 3 different segments broken down for you guys. We have cloud computing, which is probably where we're going to see the most growth. We have consumer electronics, which is the laptops, the wearables, other things like that. And then we have our smartphone, which we don't really anticipate a whole lot of market share growth, but we do see some industry growth overall. The other EPS is going to be licensing and then things like automotive. That's why it kind of takes up so much licensing. I think the ratio is 1 to 1.6. And then total EPS is set to almost double by 2027. Going over our baseline optimistic and pessimistic EPS, we see optimistically ARM EPS could grow by double by 2027. Baseline, we're kind of thinking $2.20 by 2027. If we look at the pessimistic side, we're thinking less than $2 by 2027. So as far as our PE evaluation goes, we used a 93 PE for our forward looking 1-year estimate. That combined with our EPS projection of $1.40, we would get a 1-year price of 127. Pessimistically, we projected $93, and then optimistically, we projected almost 140. Using the DCF model, we projected an average value baseline of $37, pessimistically of 31, and optimistically of 45. Again, ARM has no debt, so these are all just pretty straight across the board. We used a weight of 50-50. We were much more kind of weighted towards PE at the start of the semester, but given recent market adjustments, we reevaluated and went back down to a 50-50 split. Baseline target price of $82, pessimistic 62, and optimistic 91. The current price was 98. I believe it is 102 now. So as far as portfolio fit, the stock has only been publicly traded for 6 months, so we didn't really want to do a traditional correlation matrix. Kind of just wanted to talk about how it fits as far as like weights and stuff. So technology, Spellman fund is pretty on par with the S&P 500. Semiconductor related stocks take up around 12% of the fund. Overall, if we wanted to buy ARM in the future, we would probably have to sell some shares of either Applied Materials or Intel to get in. Overall, we believe ARM could have a promising future. They're going into some high growth areas, one being cloud computing, the other being consumer electronics. They're expected to increase their royalty rates in the near future with their ARM v9, and we would like to see that continue as they release new IPs. ARM is heavily committed to R&D. They actually reinvested 40% of their revenue in the fiscal year of 2023 into R&D. Just because of the market conditions, market price, and some of the economic uncertainty, we cannot recommend a buy at this time, but we would recommend other groups and possibly the board to consider buying ARM in the future.
Sweet. We'd like to open it up to any questions at this time. Hi. Hey. Would you like to ask any questions? Okay. I'll wait till we through some of it, please. You wanna go back to page 10 real quick? Okay, 99% of, they have 99% of the market of the smartphone.
Correct,
Okay.
yeah.
Is Apple, does that fall into US or China or both? You know, when you're looking at their customer segmentation, geographic segmentation.
I would say that we don't know for sure based on geographic. I believe they said that they have 99% of all smartphones, so I believe that they are including the entire world as that. So yeah.
So if I sell an Apple phone in the US or I sell an Apple phone in China, would it appear on this chart as being US because my customer is Apple, or US and China because then customer?
I believe that would be US. So you have like Apple, and then Huawei would be another customer of ARM. So I believe that would fall under China.
Okay. US has been, there's been legislation recently here in the United States protecting the chip segment in the interest of national security. I don't think, well, maybe I'll leave it to you guys. Do you think China's gonna have a similar response, and what does that do to a company like ARM, who's not a US company, but are they gonna be caught in the crosshairs? And are there some concerns about them being able to sell those chips and manufacture those chips there?
Yeah, definitely. I mean, so we kind of touched on it a little bit, but there is actually kind of like a separate company, which is actually more of a customer of ARM, which would be ARM China. It was split off by SoftBank, and that was kind of to get around some of the China tariffs and some of the issues with China. The only real risks I see there would probably be like some of the open source architectures. If you could, you know, kind of curb ARM and go to that, or if somehow, and I don't see this really happening, but there are things in place to stop ARM China from, you know, becoming bigger and coming out with better technologies than ARM. There's certain limits on like what they can actually do. So if like somehow ARM China became like very independent and just kind of did its own thing and took over from like ARM Holdings UK, I think ARM is in like a good position as far as like the whole like China geopolitical issue goes.
Is it a wholly owned entity? Or has it been spun off? Is it a joint
It's been spun
venture?
out, so it's owned by Chinese investors.
Interesting.
Alright, so sorry for being the slow one here. So this is an IP company. Are they generating the IP themselves? Or are they just a holding company that sort of buys the IP?
Yeah, so they design and create their own
Themselves.
IPs themselves, yeah, and then they sell that to other companies for licensing fees and royalty fees.
So they have an engineering team that does that?
So if you look at their KPI report, I think it's like 70% of their employees are engineers. Yeah, so
So and their engineers are all located here?
that I do not know.
They all,
I believe they're primarily located in the UK right now, so I believe most of their activities would be in the UK, but it's just traded over here in the US, and
Okay.
a lot of their businesses in the US.
okay. What, given the globe at the moment and thinking about sort of intellectual labor like engineers like this, what risks does the company face when when the IP is, you know, so crucial? What are some risks that they face?
The engineers itself or the company?
Company,
Just probably the cyclical nature of, you know, the industry, you know, in 2022, it was a really down year for smartphone sales in general. It's picking back up in 2023 and they're expecting it to be good in 2024. I know we met with Kevin Spellman, he was our mentor, he said he saw that in the pandemic, a lot of people, you know, it boomed, it skyrocketed because people wanted to upgrade their smartphones or tablets, you know, anything that has to do with ARM related products. So the industry was down and then it comes back up, but then it'll probably go back down again next year. So that's the one issue I think that they face.
so I was asking a non-financial question, right? I was asking about sort of the human beings who are responsible for the innovation at the end of the day that you're trading on, right? And sort of given the global market for engineers, right? Like the bigger the market is, the easier labor flows. That's great, but given what we see in the world today, it's sort of everybody's, I mean, like, you know, protests going on over here at the moment. So the world is sort of like dividing a little bit. What does that mean then potentially for the IP that the engineers generate? I mean, do you see a risk to innovation for the company in the future? What's their pipeline for talent? Where are they getting it from?
Yeah, so I know like obviously like rocket science in the US, you have to be like a US born citizen, things like that. And I mean, that does raise good questions. Like if we were in like some sort of global conflict scenario where like big superpowers were involved, would one claim that like, hey, like would the UK claim like, hey, you can't sell technology to China, you can't sell technology to Russia, India, whoever. I think that's definitely a risk. I mean, there's just a lot of uncertainty. I guess, yeah, I can't really say for sure. I mean, it's definitely something that would have to be looked at further.
I just want to make a point that it's not always just the financial variables or financial future, right? There's sort of lots of other things in the background that could jeopardize their position.
He's an economist.
Yeah,
I think.
I didn't understand any of the ratios you were talking about anyways.
All that was.
On one hand, on the other hand.
We appreciate the different perspective.
Could you go to slide 13, please? It just went by so fast. I'm still trying to get a handle on the valuation. So we've got a price to book that's is 3 times the industry average. We've got, our return on assets is stronger, but it seems like however you want to price the stock, it's exceptionally high on a relative basis. So combine it with the risk that we have here, and we've got a target price that's something like 14% below where it currently is.
Yeah, it was around that.
Okay, help me understand why I want to own that.
It's kind of the conclusion we came to too.
Yeah.
You don't.
Yeah. Yeah, they have a hold on it. Why do I want to own that?
Or you're saying. oh,
Yeah. So there's a third option, right? So we can either buy, hold, or sell.
Right,
Right.
so it's not in the portfolio right now. We were recommending at the start, we were recommending to buy
Okay,
it, so.
my mistake, yeah. I didn't do enough homework.
Well, we could sell it short, so.
Yeah.
It can still be a sell, it could still be a sell if it's not in the portfolio.
So you mentioned AI bubble, kind of a generic term. What's gonna cause an AI bubble? Is it gonna be earnings? Is it gonna be PE ratios are too high?
I think mainly it's gonna be like a kind of a demand issue. Also, there's a lot of risk with like a recession. Like, our company's really gonna prioritize investments in AI if things are going bad, like if their income statements are kind of feeling squeezed. I guess like the biggest thing that we're concerned about is when bad news comes out, this thing drops like a rock. And that really wouldn't be a good thing for our fund. I believe it was ASML. They came out with some bad news and this thing lost 30% market cap in one day. So it's pretty concerning. Originally, we did want to recommend to buy, but when things like that keep happening throughout the semester, can't really recommend something like that.
We had another bubble, a couple years before you were born, called the internet bubble. Intel, Cisco are two of the largest, best companies out there. I don't believe they recovered the price that they were at in 2002. Yes, Cisco. Yeah, and it's all PE ratios. It's going down. We kept saying it was a new paradigm. 40 times earnings, that's okay for these guys, That wasn't. So I worry about the 93 PEs that we're looking at.
So on that, in that vein, so you've got trailing 12 months PE 83, it was 104 last year. Go to your page 22. I like that we've got different PEs. First of all, why'd you use different PEs for different scenarios?
So I would say they're kind of, like I said, there was actually a single day where market cap dropped like 30%. And so a lot of the analysts, FactSet, Value Line, we're seeing that probably around like next year, this time, we would be sitting at like a PE of 90. And then after that, it was like, okay, it's probably a PE of 60. Optimistically, you'd probably want it to be a little higher, obviously. So it was still kind of at 100. It still is around that range. So we kind of just kept it there for optimism's sake.
Would you pay a higher PE, so higher price per dollar of earnings, if you're growing faster or slower? So if I'm growing at 20%, would you pay 98 times earnings? If I'm growing at 10%, would you pay at 90? So when I look at this, the logic to me was, hey, optimistic, we're growing faster, we're demanding a higher PE in the market. So that one made sense. On the baseline though, at 93, I had a hard time with an increase in the PE from 83 to 93 in the baseline, when we already think 83 is too high. And then the pessimistic, maybe that's more in line. But that it makes sure we kind of understand why we might pay a higher PE for another one. The last group came in with a company that was trading a higher PE than the rest of their peers. Why is that? So now we're looking at this scenario. Why do we assign a higher PE in the optimistic or pessimistic? You're right. It has to do with the outlook, growth, market sentiment, whatever you want to talk about. But I don't know that if you look historically at these types of companies, that you see PE accelerate from here unless growth is accelerated. So if we're gonna see things start to slow as the company becomes more mature, you tend to see those PE ratios come down. I don't know that.
I think it might have been just an issue of like our data, kind of how we collected it over the semester, I would say. I mean, if I were to give like a baseline just from my intuition, I would say probably like 80 would be more in line, kind of where it currently is. I think like as a group, we kind of came to the consensus that a stable PE for this company would be around like 45, anywhere between like 35 and 45. So yeah, it definitely should go down in the future. Yeah, that's all I have to say.
So then I just have two comments. One, I love that comment. We as a group came to a consensus because sometimes you have one person that your job is this, your job is that. So I like that you talked through consensus. The other thing I liked from your presentation was the fact that you reached out to a contact at the company to get some additional insights. That's something we haven't seen in the past. And kudos to this group. Oh, and then the last one was on the ESG slide, you actually had a meaningful comparison. 20% female employees. Let me compare that to the industry so that it actually to put it into context. And that's good when you're giving a presentation like this to deliver some context with any numbers that you throw out there. So good job on those things.
Thank you. Okay, with a minute left, I'll give you the sincere golf clap. Yeah, sincere. I don't know how they do it. The same kind of building on what Tyler says, I love that you guys came in and actually had a hold on it. You ran your analysis and then you made your decision. Too many people come in with their mind made up at the beginning of semester that we want to buy this stock, and then they force their numbers to get to that thesis, which is do not do that in real life because it will blow, that project will blow up in your face and you'll be like me, unemployed. So don't do that.
Tan, I was gonna say.
Baby. Got some projects on it. And then you guys talked about that, how you changed your mind over the course of over the semester. So that's good. Do your analysis first, then you make your decision. So we only got a minute, so I'm gonna give you guys homework because I gave the other people homework too. So you talked about in two instances, market share growth. And that growth was higher than your baseline growth in earnings or revenue or whatever that was. Later when I see you tonight, walk me through that thinking that your market share, you're picking up market share, so you're growing faster in the market, but yet your earnings are growing slower. That's interesting. Think about that. Explain it to me later. I really want to know.
2 by 2 AM.
And we've made some bad decisions at 2 AM.
Good afternoon, everyone. We're Home Depot. I'm Brooklyn.
I'm Weston. I'm Parker. I'm Matt.
I'm Chandler.
So today we're going to go through a quick overview of Home Depot as a company. Then we're going to touch on some of their risks as well as their financials. Then we're going to touch on their key growth drivers as well as their valuation. And then we're going to end with the portfolio fit for the Spellman Fund as well as some of our thoughts. So first, for a business overview, I'm sure most of you have either been to a Home Depot, heard of them, or seen the commercials. So Home Depot is a retailer in the home improvement sector. They sell everything from hardware to paint to appliances. They are currently the leaders in that industry. They have about 48% of the market hold there. They're followed by Lowe's, who's their closest competitor, and then some other small private companies such as Ace or Menards. When breaking down Home Depot's customers, we're going to be looking at DIY, which is do it yourself. That's going to be people like me and you who are just going there to do some projects. And then we're going to have our pro customers, and that's going to be your contractors. They're going there to get their stuff for the day for their jobs. When looking at that, we broke it down for Q2 of 2022. They were looking at about 75% of their customers were that DIY. But then in their recent earnings call they had in February, they mentioned that for Q4 of 2023, they were about even 50-50 between that DIY and that pro. So an overview of the stock, we are recommending a buy for you all today. We believe that our valuation has shown that the company is strong and can earn a return of 17% at our target price. They have financials that have been strong compared to the industry as well as their competitors, and we'll touch on some of those later on. And as well, we believe that the housing market is going to be heating up in the future with those lowering of those interest rates. Now, we know that they recently have talked about that and we're a little unsure of where the interest rates are heading. But in a New York Times journal, they talked about how people are done waiting for those interest rates to drop for their home buying or improvements. That's just because families are getting larger and they need to move out of those starter homes. And the elderly need to be in places that are more age friendly, such as their house, they can't get up those stairs anymore, so they're gonna be looking in that market. And for the past 3 years, they've been holding back, but they're thinking that they can't do that anymore. So as you said, we're recommending a buy. We're looking at 34 shares, which would be about 2.5% of the fund. We have a target price of about $384. And as of yesterday's closing price, they're at $335. So that would be a target return of about 17%. For their business, we believe that they have a steady revenue, which we'll touch on, as well as they serve both those contractors and those regular customers coming in. And then they're trying to expand on that pro market, so that's gonna be those contractors, and they had their SRS deal that they're having go through, and that's something that they're working on to bring in more people for that pro market. Their key drivers are gonna be decor and building materials, and then we're gonna touch on the risks of interest rate as well as debt. So here we have a graph of Home Depot stock price. We also put the 30-year fixed mortgage rates up on there because we know that as a home improvement store, mortgage rates are gonna play a role for the company. So we can see that through the housing market recession in 2008, they had a pretty steady stock price, and then in 2012, they took off. We can see that when interest rates plummeted in 2020, that their stock price shoot up, we see that big growth, and then we see it come down a little bit as those interest rates were picked back up.
So now going over the revenue cycle or streams, decor makes up about 33% of their revenue, so that's their appliances, paint, kitchen and bath. This sector's been growing at about 10% per year over the last 5 years. And building materials, which is their largest segment, makes up about 36% of their revenue. And this is their lighting, building materials, lumber, millwork, plumbing, etc. And lastly, hard lines, which is their hardware, indoor, outdoor garden. This makes up about 30% of their revenue and has been growing at about 7% a year. And then as we break down those three segments, Home Depot categorizes all of the revenues into 14 streams. So you have decor here on the left, building materials in the middle, and hard lines on the right. What makes Home Depot so attractive is that their revenue streams, all of them make up about 6 to 8% of their revenue. So it's very diverse in the way they gain revenue. And so it's not mandatory, or it's not driven by one or two segments. And so another big revenue stream for them will be the SRS deal. We'll talk more about it later on, but they're, with the acquisition supposed to happen in the fall of 2024, this company has driven about 10 billion in revenue last year and created about 1.1 billion in EBITDA. So it's a profitable company. They're in over 47 states. And so this will help Home Depot gain market share in their professional segment.
Now touching on some of their ESG, some important things for Home Depot are how they source their products. So one thing is sustainable forestry. So having some kind of certificate for their wood that they're doing sustainable practices for the environment, as well as one thing they're concerned about is the packaging. So making sure that it is biodegradable film. And just some other main things to talk about are making sure that they're treating their employees right, giving them development opportunities, as well as allowing themselves to express themselves on the job. And one thing that's kind of interesting as well is they were caught sharing their data, customers' data with Meta without consent. So this is likely to give them a better edge on their customer to find out more about their customer and how to target their ads. However, that was viewed unfavorably as there was no consent for customers. So they would take receipts and then customers email and then be able to send them more direct ads, which was viewed as unfavorably. So we rate them as neutral. However, we think they have a positive future outlook as they invest more in their employees and work to help the environment better. And one goal they have is to be energy net zero. So having solar farms on top of their stores where it makes sense.
And so if we go over the risk matrix, the two that I really want to point out are the higher interest rates. We've seen this in the last year with Home Depot in 2023. They did have negative 1% sales.
That's really the biggest issue that they have. We've seen a decrease in the DIY revenue streams, and that's why you've seen an increase in pro for their split in revenue. So they're really looking to gain more in their pro market share, as it makes up about 20% of their customer base, but relies about 50% of their total profits. And then increased debt is another risk with the SRS deal. It's about $18.25 billion. Most of this is gonna be paid for with cash on hand, but as well as some commercial paper. And they will acquire some 5.1 billion in debt from SRS as well. But as Parker will mention later, for the debt, it's really not too big of a worry for us, as Home Depot has an A credit score rating, and they mature their debt over many years, so it's not a short-term issue for sure.
Now getting into some of their key financials, so for comparing Home Depot, they have Lowe's, but other than that, there are no public companies similar to them. So we decided to focus more on the retail space, this being Walmart and Target. So with PE, they sit just above about industry average as well. And one thing to note as well is these home improvement stores have a higher net profit margin. So as you can see, where Walmart and Target sit around 1 to 2%, Home Depot is around 10 to 9% on average. And ROA as well, they get a better return on their assets. And the main one we want to focus on today is sales per square foot. So Home Depot, they have larger stores, 100,000 square feet. And look at their competitor Lowe's, they do a lot better job of optimizing their sales space. And they're right up there with industry leader Walmart for retail, because Walmart is the largest retailer, and Walmart gets a lot of data as well, and Home Depot is beginning to dive into more of their data and the more e-commerce as well, and really developing their app so customers know where to get things. And for their growth as well, they pay less to get it, which is one thing that we found is really attractive. With their lower PEG ratios, you look at Lowe's, which is 7.7. Lowe's is paying a lot more to get less growth than Home Depot. So that's one thing where you compare to some of these other retailers, Home Depot does well, and they really focus on a few key metrics which help drive their profitability. Now looking at their debt, they have about 40 billion in debt, and one company policy they have is they use capital expenditures, and they use about 2% of their annual net sales to do so. So this turns out to be on average 3 billion in new debt issued per year. And one expense one ratio they've been getting really good at and knocking down is the EBIT per interest expense, which is above the industry average. And one thing is, during COVID, we saw this rate up to 15 to 14, and with these higher rates, we thought it would stay higher, but they've done a good job knocking down their debt and paying it off to lower their ratio, which it's going to show you that despite how much debt they take on, they're also paying it off at a good rate and not getting as exposed to higher interest rates. As you can see, going to 2030, they still have a lot of high debt. This was issued before we saw rates take off. So they have lower lending numbers. If you look at like 2040 and 2035, where they know that they're going to have to pay more for their debt. So they're going to be cautious and take debt. And while we aren't concerned about their debt, one thing is if they refinance some of this short-term debt, we know that they're going to have to pay probably double what they're paying now, because typically they target a 2 to 3% on their debt. And lately they've just been getting below 6. So that's a huge jump and a huge expense in the company. However, we believe that with proper debt management that they can handle it.
It's kind of getting into their growth drivers. We landed on building materials and decor, with decor being their fastest growing sector at around 10% for the last 5 years, and building materials at around 8%. One thing for building materials we really think is going to help boost their sales is the acquisition of SRS Distribution, which is the fastest growing distribution company of building materials to those pro customers and those contractors that Home Depot is really looking to grow that section. We think this is going to projected to grow the market by about 50 billion here. And then kind of looking at interest rates, we know that this has been kind of talked about a lot recently with coming out that they're going to hold right now, and then that with the job market coming out, that came a little below projections. So we think that should help our outlook in terms of interest rates coming down in the next few years as well, which should help our sales as well here.
So going off those key revenue drivers, we broke them down into 3 buckets we talked about earlier: decor, building materials, and hardlines, with their respective growth rates of the last 5 years. And we extrapolated these figures out from 2023 out into the next 4 years and got these figures you see here. One thing I would like to note is in this valuation, we did take their trailing 12 months net profit margin, which is lower than 10. However, in other times, as you saw in 2022 and 23, that figure is a lot closer to 11. So some of these valuations you see here are a little more on the conservative side. Then as we move on, we break these down into an optimistic, pessimistic, and baseline scenarios. So as you can see here, for optimistic EPS, we really went with a best case scenario here. We got super optimistic. This is if that SRS deal does go through, interest rates do maybe come down this year. We really do project growth like this because we have seen this in the last 5 years. Not to mention in 2021, they did have 30% EPS growth. Going down to the baseline, 8% is about their average from like the last 10, 12 years. And so that's what we did our baseline based off of. And then pessimistic, going into this next year and beyond, we did stay pretty modest on it. Don't really project much growth in the next year or so, and then see slight growth in years to follow. And yeah, that's just the way we see it. We feel good about the baseline. We think it might be between baseline and pessimistic, but you never really know what the economy is going to do going into the future. So moving on with our valuation, breaking down into the PE method and the discounted cash flow method, we take the PE estimate from the 1 year ahead, our EPS estimate, and get target prices for the listed scenarios. Same thing with the discounted cash flow method between the two values you see here up to an average. And then we did take a 70% PE because we felt like that figure was a little bit stronger as they are financing a lot of their operations currently with free cash flow. So we did take a little more PE into consideration for the target prices you see here. So obviously 51 is super optimistic, but we want to really highlight the upside that this stock could have if interest rates do really go down in the next year or so, maybe a little bit past that. Baseline is really where we could see it going in the next year with the acquisition they just had and where we see interest rates could get cut. And then pessimistic, we really feel is like a floor, maybe a little bit below, just in case, interest rates do get prolonged even longer than we're thinking or even the Fed is thinking. So at a current price of 335, we do project about a 17% target return for the next year. Going into the portfolio fit, we do have our correlation matrix with the other securities into the portfolio. And then also with the fund itself, Home Depot would be about the 13th highest correlation. So it would be about par for the course. It has a 0.98 beta, so it's right around the S&P 500 in terms of volatility. One thing we really wanted to focus on is the Spellman Consumer Cyclical. I don't know if you guys know, but it is pretty much severely underweight. It is under that 5% benchmark that we were looking to keep close with the S&P 500. S&P 500 being at about 10.5 and us being under 5. So with our purchase, it would get bumped up to just under 7%, which would get us closer to that target benchmark. So in summation, we are recommending a buy, like we said earlier, with the target price of $384 would give us about a target return of 17%. Obviously, there's some varying factors in the next year that would change that, but we really feel strongly about our projection. Once again, they're looking to expand in that pro market. These are repeat customers. These are the people that are coming in, getting big purchases and trying to get everything they need for the job that day. Next, like we said, they're really looking to expand in that decor and building materials. That SRS acquisition would really help boost this and drive this. And then lastly, as we've seen as we've shown back with their stock price, Home Depot has had the versatility to navigate economic downturn. They've shown an ability to be able to navigate this and really keep themselves propped up even when economic conditions are not favorable. So lastly, we would like to buy 34 shares, make up about 2.5% of the fund. The fund is currently underweight, as I stated earlier, and we would like to get these shares in there and get that consumer cyclical weight up.
What was your growth rate projection in your baseline scenario again?
Right around 8%.
8%.
Yeah, and that is that is just what the average where they've been in the last 5 years through the volatility of the economy, and that's what we do see what could happen, taking into account for the highs and lows in the next 5 years or so.
The economy is picking up or slowing down over the next couple of years?
Right now it's definitely really hard to say, there was a job report that did come out, I think either yesterday or today, and showed that job growth is slowing down a bit, which should help bring down that inflation. So hoping interest rates maybe do get dropped sometime in the near future, and then we could really see the growth we're hoping for.
that's great on the inflation front, but doesn't the whole reason it's slowing inflation is because people aren't working, they have less money to spend, and doesn't that have a negative impact on consumer cyclical companies?
One thing with Home Depot is, as you talk about the mortgage rates where you see a drop, a lot of this is in the home buying as well, so I feel like we're kind of in an unprecedented time where people have been sitting on cash since the pandemic, or and we saw how much households gained money from the pandemic, and now they're kind of just having to weather the storm with these higher rates. So we think that people are going to be buying more homes and getting more active in the housing market and like fixing up their houses and reselling that. Heating up housing market, especially those at like the top line, we think could really drive some sales for Home Depot.
Okay. If things are slowing, is 30 times earnings cheap, or would you say that's a little rich heading into an economic slowdown for a cyclical company that's growing at 8%?
I would not think that is bad, because for like a cyclical company, you know, you're gonna get diminished earnings, but that price baseline is still holding higher. So while like other companies in the market are gonna see that, a high PE for cyclical in a recession, we don't view as bad.
In a recession or before
In
a
a
recession,
recession.
leading up to, where I'm getting at is usually with a cyclical company, what you tend to see is that PE ratio is low when we anticipate that earnings are gonna slow. And then in the recession, when earnings have pulled back, then you see that PE rise in anticipation of future growth. You're showing me a baseline projection with 30 PE and the potential for an economic slowdown. And, you know, to me, that we're not squaring the circle a little. Not squaring the circle? I'm looking at that thinking maybe our PE ratio, the PE ratio that you assigned might be a little bit high, a little bit optimistic. Looking at that, that's just me. I also think you guys did a great job on a handful of things here that we should probably talk about. I like the way you walked through slide 15. Explained why that might be a conservative projection in terms of past growth rates, EBITDA, all that. That was great. And then the only other question I had was the earnings before interest and tax divided by the interest rate. Why did you select that particular ratio? Is it something the management said, something that you were keen on? Why do we highlight that particular one?
Can I go back to this slide?
Yeah, I can go back to the slide.
That was just one thing where like obviously like we didn't like include their ROE, so the way they view things, like looking at their 10K, trying to understand like where the company goes. That was just one of the metrics and
Yeah.
I had it. Okay, sorry about that.
yes, like we reached out to investor relations, like kind of trying to understand and get a better idea of their financials, and this was one of the ratios they pointed us to that they view like very strongly. And obviously they're beating the industry average, but you know, it's really them and Lowe's, so it's probably just highlighting that they're beating out a few, you know, small retailers and that they're below Lowe's. But they just said like they do their accounting and their balance sheets a little different than we would see of a typical company or something that we would be kind of more used to seeing. So
No, it's interesting.
Does the acquisition change that, the debt structure? How are they gonna pay for that?
Yeah, they will assume about 5 billion in debt. It didn't say exactly how they'll spread out that debt over the next couple of years, but it's still in approval process right now. So if they get approved by the FTC, then it should go through in 2024, or the end of 2024 this year, but not exactly sure how that debt's gonna be structured going forward.
Yeah, and I'm just unclear on this. You've got long-term debt. Is that their maturity structure?
yeah, that's facing maturity.
Okay, so we've got long-term debt maturing in 25, 26. So it looks like they're gonna have a significant repricing of their debt over the next couple of years.
Yes.
They may be adding more debt through the acquisition. They're relying on managing their EBIT to their interest expense as an A-rated company. Are they an A-rated company post refinancing the debt and acquiring more debt, assuming FTC approves of any kind of a merger? It's a big assumption, right? But let's say it all goes through. Is that change the interest expense? And if so, does that change your thoughts on whether or not you want to hold this?
I think, yeah, it changes their interest expense a little bit, but they have 9 new stores being built this year. 9 in the country and 5 out of the country as well. And so if you see their sales per square foot, I think they'll catch up on the interest expense that they have, as well as if this deal does go through, they have market share to a whole nother professional market that they didn't have before. So they don't have to rely on the do-it-yourself improvement, even if the market is a little slower. In terms of housing turnover, it's, I think, a 40-year low right now. And so I think if interest rates fall and we see the housing market heat up, you're gonna see not only an increase in the professional build, because the US were behind in just homes available for Americans. I think it's like a 4 million house deficit in terms of like just not enough supply for the demand. So I think they will see a positive growth even if they have to increase their interest expense currently or in the near future.
I just had a qualitative question. Basically, how are they going to expand that pro market? Is it just through the acquisition?
Yeah, that acquisition, I mean, they're the fastest growing company in the kind of contractor pro market that they're looking at. Because I think they're at about 20%, right? In terms of pro customers. So yeah, I'm looking to really grow that with that acquisition. They've been growing. SRS, I think, for the past 5 years, they've been growing at about like 30% revenue wise. So that should add a big boost to them. I think their revenue is about 6% of Home Depot. So I think that should give them a big boost in that area.
Do you go to slide 14, please? You highlighted throughout the presentation their diversified revenue set, certainly a strength. You show here growth rates for EPS. I think in other spots you showed growth rates for revenues. Well, I think maybe ask the question: are these growth rates here on EPS the revenue growth rates, or are these different assumptions?
These growth rates are based off of the revenue from each individual department that we had.
So do each of these segments have the same profit margin then?
That's what we use for the calculation. Yes, we use the same.
We took the company's overall profit margin onto these.
Did you look to see if any of them have different profit margins?
I don't think it reported that.
I believe they would.
Because what would be interesting to me is, they're relatively similar growth, they're diversified, but does one segment have a higher profitability? And is there opportunity that maybe it's this acquisition that they are increasing their revenues at a faster rate in the future in a higher profitability that's gonna accelerate their EPS? It seems like you're just doing a kind of a baseline across the board growth rate. So that was kind of the basis of my question.
Along the same lines, you guys made a couple comments that I thought were interesting. I'd like you to expand upon this whole balance between the pro and the DIY.
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 I don't know what you're talking about. Anywho, I went over my head excited. I think you made a comment about how the percentages have moved to become more equal, and was that because the do-it-yourself customer actually saw a decrease in revenue such that the pro, like, how would that mix change? Like, it wasn't just that pro grew to be faster, it was a decline.
Yes.
The do-it-yourself, the everyday guy like me going in there buying,
Crooked two-by-four?
soy. I don't know. Totally sidetracked. Okay, so along with that, so you made that comment. So it's basically the pro, that segment's moving down, pro's moving up. But you did make a comment, going back to the profitability, I thought that the pro segment was actually more profitable. Did you say that? I think Weston might have said that.
Yeah, it makes up a large percent. So their customer basis is like 20% pro, and it makes up about 50% of their revenue.
The revenue, okay.
Compared to the DIY.
So they spend more.
Yeah.
Yes,
Okay.
so they're doing bigger projects,
Okay.
going and buying a lot more.
Okay, I'm just trying to wrap my head around all this. I think I might have had somewhere to go, but it might take me because you guys threw me off.
You're the one talking about DUIs.
Not driving.
This isn't gonna be in your research. I don't know that it should. It's more of a, since you've been assigning homework all night. Fed cuts rates. they're impacting the short end of the curve, though there's some changes in the expectations on the long end of the curve. We talk about a Home Depot and we think about the people that are spending the money at those stores. If it's home improvement type stuff, is that gonna be impacted more significantly by short-term, long-term interest rates? If it's the new construction, is that gonna be affected more by short-term or long-term interest rates? So as we start to look ahead in this environment of possibly seeing some rate cuts, but maybe you don't see that same, you know, if they cut 25, it doesn't mean the 10 years going down or the mortgage is going down 25. What does that do to the outlook here going forward in terms of how consumers are financing the different types of Home Depot spending activities?
I think that's one thing that they've mentioned on some of their past earning calls where they call it sort of like a weathering of the storm. So last year they had just like a -1% sales growth. So obviously they had supply chain issues. Obviously every company did after COVID. So I think one thing that they said they would focus on more is kind of like being ready in the case that, you know, they start picking back up again. But obviously like they want to make sure that their stores are, you know, updated with all this technology, especially on their apps. So I think our pessimistic should be pretty accurate that, you know, they might not see growth for the next 3 years, but they're kind of setting themselves up and building themselves up to have the inventory, you know, in case the consumer will have to wait off or, you know, it gets obviously more expensive to build a house that, you know, maybe we see, you know, our optimistic, you know, scenario not really happening or so on.
I'm just thinking, if I'm doing a project, short-term project, it's probably on the home equity line of credit, which tends to be a short-term floating rate. Whereas a new home is typically gonna be purchased with a mortgage, so a long-term fixed interest rate. So you know, in a scenario where we're cutting the short-term rate, and who knows what that necessarily means for the long end of the curve, you could see a pickup in some of the home gamers activity versus the commercial type activity.
Remind me of the PE you used in your PE valuation. Baseline 25, 28. How does that compare to what it's been historically?
I think the historical average is about a 22, so it's a little bit more optimistic, but I think when we first started, obviously the price was around 395, and they have since fallen off down to 335 currently. So I think that's why we kind of chose, I guess, a little bit more optimistic PE, but if their growth is higher in the future, then I think they'll have a higher.
So you're thinking the market will revalue the valuation, the PE, based on your EPS estimate of 16.28 compared to what it's currently pricing at?
Yes.
Okay, right.
So you'd mentioned that the free cash flow analysis, you didn't like it as much because they're using some of that cash flow for funding additional expansion, and things like that. So is that's included in the free cash flow to the firm, or is that investment activity? I don't remember all the categories. So as we go down free cash flow to the firm, free cash flow to equity, where does that come out? So that's coming out prior to, so if we put the capital expenditures back into the cash flow, we'd have a different valuation? Or is that are those capital expenditures already taken out of the free cash flow of the firm?
I think just in the projections, I think it's more or less that's what Home Depot is expected to do. We use value line as a reference for that, and I think it's, I mean, I wouldn't say it's completely factored in, but I wouldn't say it's not either. I think it's somewhere in between, and that's where we did end up feeling better about the PE, just maybe not giving as much attention to the free cash flow side of it.
I gotta tilt to academia. Where does that come out of? So if we're spending cash on those types of investments, are these numbers after that's been taken out?
Yeah.
Okay,
You got that one.
then good job. Good job.
Any last minute questions or you got a homework assignment plan?
Yeah, nah.
Are you recommending a market order on that? Or is there a limit that you want?
That's old school for, are you recommending a buy?
Yes.
Oh, correct.
Yeah, well, no, they said they wanted to buy, I was just wondering, today's price.
Yes.
Right, good job.
Good evening, everyone. I'm Angelo.
I'm Ben.
I'm Hunter.
I'm Tyler.
And I'm Chris. And today, we're gonna provide analysis on our chosen stock, Target, where you can expect more and pay less. So today, we'll begin our presentation with an overview consisting of Target's business model, current and future economic conditions, as well as how Target makes their money. Then, we'll jump into their risks, as well as their financials, and our key growth drivers, which we believe to be e-commerce and private label brands. Then, we're gonna discuss our valuation numbers for Target, the portfolio fit into the Spellman Fund, our recommendation, and lastly, our summary. So for Target's business overview, each year, Target continuously generates $100 billion in sales. Their revenue sources are primarily their physical store, but also their online sales as well. This is then complemented by their Target Circle Rewards program, as well as their newly rebranded Target Circle credit and debit cards. Also, Target has created a foundation that supports current and future guests, team members, vendors, communities, and shareholders extremely well. We view Target to have immense growth opportunities for the future, and as a result, we are recommending a buy for the Spellman Fund. Their key growth drivers are going to be their revenue as well as their dividends. And I want to draw your attention to the right side of the screen where you can see that Target has paid shareholders dividends since 1967. They've never missed one single payment. And recently in 2023, they hit their all-time high for annual dividends per share at $4, showing continuous growth since 1967. Lastly, they always deliver strong financial results regardless of how the environment around them evolves. Especially, this is important because Target is a consumer cyclical stock.
Like Angelo said, we're recommending a buy of 50 shares at $158, which would come out to about 1.7% of the Spellman Fund. Our target price is around $180, which would give us a target return of about 13.5%. And like Angelo said, Target is a large US retailer with consistent growing financials and dividends. And we believe those consistent and growing financials and dividends are from the key growth drivers of private label brands and digital services expansion, along with some of the risks being supply chain disruptions, greenwashing, and cybersecurity. So looking at Target's stock price for the last 3 years, it peaked at about $250 in 2022, bottomed out at about $110 in 2023, and is currently trading at around $156. Looking at the trailing 12-month for some of the key statistics, it has a PE ratio of about 19.5, an ROE of about 33, and an earnings per share of about 9.4. Looking at Target's gross profit of $28.6 billion, it had about a 28.6 gross profit margin, and their growth strategy involves investing in expanding guest services, operations, and digital experiences, as well as launching new low-cost brands such as Dealworthy, and they're focusing on these current private label brands because they contribute over $30 billion in annual sales. Now looking at the revenue streams for the last 2 years, it's about an 80%, 20% split between in-store and digital origin. And looking at the sales by merchandise category, beauty and household essentials, as well as food and beverage are the two main areas. And this is where Target is really working to expand their private label brands. Now looking at the ESG standards, some of the pros involved, they're working on 100% renewable electricity by 2030. And as of 2022, they have 60% renewable electricity across stores, as well as 900,000 volunteerism hours recorded and 1 zero waste certified location. Some of the cons include consumer backlash over greenwashing, which is basically lying about emission standards or stuff like that, as well as fast fashion, which is the idea of producing a lot of clothes and then the clothes fall out of fashion rather quickly, which leaves a lot of waste. ESG factors are a building block for Target's future, and they plan to meet most of their ESG factors by 2030 and all by 2040. Because of this, we rate Target average.
And since Target's a consumer cyclical stock, we really want to talk about the economy. And so current rates for April for inflation and interest. So inflation is roughly at 3.5%. Inflation is at roughly 7%. We see unemployment rates hovering around 4% for 2023. GDP has increased in the last quarter to roughly 3%. We see disposable income up 1% since the start of the year. Personal consumption is up 9%. And then we really want to talk about the president's Build Back Better framework. It helps target the middle class, which cuts taxes and increasing spending for the middle class, which target market is the middle class and younger adults. For our risks, there were 6 risks that Target identified themselves, then we added a 7th with fast fashion. For financials, we see that in 2021, they were hovering around 15 for their PE. In 2022, there was a boom. In 2023, we see that they underperformed based on the industry. And the trailing 12 month is around 19.5. They're below Walmart and Costco and the industry average at 25. For our PEG, we have it around 150. It's below Walmart and Costco. And then for our future growth, we have it around 2.5. Price to book, we have it 6. Compared to Walmart, it's higher, but below Costco and the industry average. For our ROE, it's actually leading the industry. It's above the industry average, Costco and Walmart. And for their ROA, it's just trailing behind Costco in the industry, beating out Walmart. The net profit margin, it boasts a better net profit margin than Walmart and Costco and the industry average, showing it a promising company. And our debt to equity, Target actually carries more debt than Walmart and Costco and the industry average at 158%. And talking about their debt structure, we see that they currently have long-term debt of $15 billion roughly. Their current portion for the current year is $1 billion. Their cost of debt is around the 4% mark. We see on their long-term debt maturity summary graph right here, see they hover around the 1 billion for the next 10 years. Then everything after 10 years is summed up, it's roughly $5 billion. And we can see that they're considered a very safe and comfortable company based on their credit rating of A and A2.
Target's first growth opportunity is their digital services, specifically their Circle Rewards program. They have 3 levels to this program. First being their initial Target Circle membership. This is free to join and you get automatic and personalized deals applied at checkout. Next is their Circle card. This has 3 options. You can opt for a reloadable debit or credit card, and it comes with a $0 annual fee. You get 5% off all Target purchases with extended return time and free 2-day shipping with this card. And they just launched a new Circle 360 program, which you can spend $49 a year with the card or $99 without, and you get unlimited same-day delivery and exclusive discounts that you wouldn't normally get with the Target Circle. And the goal of the Circle 360 is to gain another strong revenue stream and to ultimately maximize convenience and customer experience for every situation, whether that be order pickup, drive up, or same-day delivery. So looking at the last 5 years, we can see that customers were using Red Card less. This is what Circle Card was before the rebrand. We can see that it's gone down about 5%, but this should increase with the launch of 360 and the rebrand. The percentage of digital shoppers has slightly decreased since 2020. We saw that initial boom from 9% to about 18% in 2020, but since 2021, it's been decreasing at about 0.3% a year. And this can be summed up to digital fatigue since COVID lockdowns. And we're not really worried about this overall because after COVID, we found that middle-aged and younger generations still prefer to shop online. And we also found that more sales are being fulfilled in store. So what this means is that more orders are being shipped straight from the store's inventory and not coming from a fulfillment center across the country to your house. And what this does is it decreases the cost of filling orders. It's decreased 40% in the past 4 years, and they've used AI and machine learning in this to save money. And now I want to talk to you about Shipt. Shipt is a company that they acquired in 2017. This is basically like an Instacart where you can order from the Shipt app or the Target website, and Shipt hires these independent contractors that will go to the Target store, shop for you, and then deliver it to you. And this is important because 75% of Americans live within 10 miles of a Target. So you can see how this process of goods being shipped straight from store to your house is much quicker than something like Amazon where it has to go through the whole fulfillment process. Shipt right now is $99 a year and you get free shipping to 130 stores, including Target being the biggest one, and then CVS, Hy-Vee, Kroger, and Mayer being some of the other ones. And Target plans to use Shipt with 360 by knocking down that $99 price point if you have a Circle card. And this is going to funnel more sales onto Target prepaid cards. Now looking at the forecast, we can see in a bear case scenario, we could assume that there'd be a shift in consumer preferences where consumers would choose to buy cheaper items, sacrificing their time and convenience.
And overall, customers don't find value in having multiple channel options in the bear case. But in our bull case, consumers prioritize time saving and convenience when making their purchases, and customers value having a personalized shopping experience. One thing to note is that subscription revenue is not accounted for yet, since we don't know how many of these 100 million users that are using their Target Circle program are gonna subscribe to this $49 or $99. So now looking at their second growth opportunity, this is their private labels. Target has changed the cheap, low quality perception that store brands typically have, and they've spent over 30 years investing in 48 owned brands in all areas of business. And they use a research and design lab that makes their selection very difficult to replicate. The advantages of this are financial stability, customer loyalty, innovation and flexibility, and ultimately exclusivity and uniqueness from other stores. So now looking at one of these brands, this is Dealworthy. Dealworthy is launching in 2024 and 2025. And this is to combat a possible negative economic outlook. So when we were looking at why do consumers switch to private labels, we can see that 90% say that it's for the better value compared to the national brands. So Dealworthy is launching nearly 400 everyday basics, and this is going to compete with low-cost leaders, stealing revenue share from Walmart and Costco. So looking at the forecast for the private label brands, we can see that the bear scenario would include introducing too many of these brands, and it could ultimately dilute the impact of existing brands, and Target would then invest in other resources. But we find this very unlikely because of Target's own brand promise, which basically says that this is going to be their main growth opportunity within the near future and long-term future. And then the bull scenario is saying that consumers are building connections to these brands, and ultimately these brands are going to be able to compete with the Fortune 100 companies on the shelves.
Now moving into the valuation, here's our baseline EPS breakdown. As you can see, we chose the three, the digital services expansion and the private label brands, and the other, which is basically just grocery and non-private brand label items. And we found a total EPS of around $9 for 2023, and we projected for in the future to have a total EPS of around $11. And now looking at the bull case and the bear case breakdown for the EPSs, we obviously started with the $9 as previously stated, and then we project for the bull case that it will be around $11, and for the bear case that it will be around $10. And now looking into our valuation, we used the PEs of 19 for baseline, 20 for bull, and around 18 for the bear case. And this gave us the prices of around 190 for the baseline, and for the bear case around $175, and for the bull case around 200. And then for the free cash flows model, we found the average value from the free cash flows for baseline to be around $100, and for the bear case around $85, and then for the bull case around $100. And using this, we used the weights of 90% on PE and 10% on the free cash flow methods. And we did this just due to the PE prices being closer to the actual price of Target. So we weighed it a little bit more heavily. And then for our baseline, we found a price of around 180. And for our bear case, we found a price of around 175. And then for the bull, around $190. And then with the current price of 158 as of yesterday, we see that there, even in each of our cases, we see growth for Target. And now for our portfolio fit, as you can see, for our lowest correlation was NextEra Energy within the fund, and the highest was MasterCard within the fund at 0.5. And currently the Spellman fund only allocates around 5% of consumer cyclical stocks, and that's much lower than the S&P average of around 10.5%. And with the Spellman policy trying to be within 5% within the sector, we are currently a little short on that. And in summary, we see Target having strong financial performance, and with its consistent dividend growth and the expected growth in the digital service expansion and throughout the private label brands. And we see it as one of the strongest leaders in the consumer cyclical sector. And we are recommending a buy at 50 shares at the current market price of around 160, which will be equivalent to around $8,000. And this will represent 1.7% of the fund. This will also help bring consumer cyclical to around 6.5%, which will bring it within the 5% range for the comparison with the S&P 500. And with our target price of around $180, and with this will give us a target return of around 13.5%. And overall, we just believe that target will be a good representation of consumer cyclical in the Spellman Fund, and now we'll open it up for questions.
That's clever.
Yeah.
You guys loved the dividend. You highlighted on one of the first slides. What's the dividend payout ratio? So how much of their earnings are getting paid back to shareholders, and has that been consistent over time? Has that payout ratio increased, decreased?
I'm not sure how it's increased or decreased over time, but I do believe that this year in 2020, or at least last year in 2023, it was around 48%. And their dividend yield has been consistently growing. I think that is sitting around 2.6%.
Is that in line with earnings growth? Is earnings growth outstripping dividend growth? What I'm getting to is the sustainability of that dividend going forward. Have we increased the payout ratio? Have we decreased the payout ratio? Has it been consistent?
That's a great question. We actually haven't looked into that, but that would be actually really interesting to look at to see the viability of Target's potential to grow.
Okay. I love that you recognize it's a cyclical name and then said, let's talk about the economy. But if you go to slide 10 again, can you just help me out with what you were showing us on the top with the inflation and interest rates?
Correct.
Keep going.
Slide 10.
Just with the economic outlook. Keep going. One more. There we go.
So for April, we pulled this from the Federal Reserve and they gave us a 3.5% for inflation from the change in inflation. It's roughly 3.5%. And then the 7% is on 30-year mortgage.
30 mortgages. Okay. To put it in context, because we're talking about the economic cycle, are these high, low? Are they moving lower, moving higher?
Currently it's a record high. I know that the Federal Reserve has talked about trying to bring them down, which would benefit Target. But since most of Target's buildings, they take out longer loans, they're gonna be, I believe it costs roughly between 5 to 7%, depending on the length of the loan for the stores.
And then also, I believe that the Federal Reserve just had a meeting where they stated that they're gonna keep rates the same for as of right now. And they're seeing or possibly seeing further decreases in the future, which can help Target do better.
I've heard that for the last 12 months. So neither here nor there. Help me understand that you talked about the debt structure. I think it was on slide 13. I'm asking a lot of debt questions today. Because it's strangling. It's $15 billion. What is in the overall capital structure? What is that? How big a percentage is that?
I think it was 158% towards debt compared to equity. So it looks like when Target does want to expand, they trust their strong financial background that they have the ability to repay it. So I think they've been choosing to go through debt instead of equity, but it might be beneficial because the cost of debt could be increasing along with interest rates. To go through equity means to raise capital for potential growth opportunities.
So they're extraordinarily high leverage.
Yes, compared to competitors such as Walmart and Costco.
Right, and previously you had your economic slide up there. Is there anything in particular that Target is overly sensitive to from an economics? Is there something I should be watching? Is GDP a big factor for them? Is the unemployment rate a bigger factor for them? What sensitivity do they have, given the level of debt they have, the cost of debt, which very well may not be coming down? I'm concerned from a consumer cyclical standpoint, the way they've structured their capital might be overly sensitive to some of these factors. Well, answer that one and then I'll get, I know he's chomping at the.
I guess looking back on historicals such as like 2008, 2009, we actually have, if you go to the appendix, they're compared their earnings or their EPS during those times, and it was still increasing or staying constant. Keep going. Keep right there, right here. So the only decrease was in 2015 due to a expansion into Canada, which ended up failing, and they just closed stores. They got out pretty relatively fast, but their earnings tend to stay pretty untouched by economic outlook. But when there's more personal consumption going on, we do see that Target's EPS or earnings do increase.
and I may have heard it wrong, but we said their online is decreasing, their online sales?
Since 2020, their online sales has been slightly decreasing, but in 2019 to 2020, we saw that huge jump from, it was about 8 to 18%. And then
Is that 8% of total sales or 8% of online sales growth?
that'd be 8% of total sales.
Okay, so it's merely, it's a shift in how the consumer is. Okay, because I think you piggyback that statement on that younger and middle age, which I may or may not be
You're younger.
yeah, okay, sure, for sure. Are prefer the online sales, so I just couldn't get comfortable with those two statements next to each other.
Well, so we believe that these sales should be picking back up. We think that people saw, or we saw this surge during the COVID lockdowns. Sorry. I do think that we should be seeing growth. This trend of e-commerce is only gonna grow within the next 4 years. And we just overall found it not really viable that people are gonna be switching to in-person. And even so, if customers do prefer to shop in store, Target has been they wanna maximize the experience. So if you are shopping in store, they wanna make that like they wanna improve that as well.
I think you're on the right track. So digital shopping went from 8 to 19.
Yeah.
And this is the trend, the negative trend isn't, it's not that people aren't shopping digitally, it's that we're returning to a slightly new normal.
Right.
But you're saying it's
Yeah.
declining, but it's declining off of a ridiculous peak. And now we return to a level where you'll see that trend. Is that the?
Yeah, that's kind of what I was thinking, kind of just like a settling down, them the overall economy trying to figure out what they want to do with their shopping. This is pretty new, this drive up. And personally, if I think about it in the next 10 years, these drive ups and online sales, they are only going to keep increasing. And like we said, we have an appendix here that shows just how many people prefer to shop online. So we can see that the younger generations under 40, they say that they shop online frequently or at least occasionally, almost 75% of the time. So as this kind of cohort gets older, we should see more people shopping online.
Especially because the younger generation is typically more technology centered compared to like older generations where they like to do things in person. I know a lot of kids have iPads and they just love playing with that. So they could grow up to kind of be more focused on that. With Amazon, we see how successful they've been. So we believe that Target can also do the same with more money and more focus towards their online sales.
So it leads into one of my questions was who are they competing against online? And what's their value proposition compared to those competitors?
So they're definitely competing against Amazon, number one online. Amazon has a revenue share of over 30% of the e-commerce market. And Target is sitting at around 2%, and Walmart is sitting just above Target. So this revenue share is small, and we expect that this should expand with this membership being less than Amazon. You can see if you want a Prime membership, you're gonna be spending $140 a year. And Amazon's grocery line, which just competes with Target, you don't get delivery as fast because of the stores as hubs. But that's as close as you're gonna get with a competitor, and you're spending $260 a year for that membership. And you're ultimately getting better
rewards with the cashback rewards.
I worry about volatility in a lot of stocks. Here, from October 21 to October 23, we lost 56% of its value. What happened? Gonna happen again.
If we could go back to what, Chris, do you wanna take this one for the recent controversy?
Yeah, so. Yeah, so if we look at the graph, in May of 2023, there was a PR for the LGBTQ like Pride Month, and it was a bit of a fiasco because there was some controversy over just some of the shirts, some of the way they were branded and stuff like that. So the stock did take a big hit back then, but like we said, it's a cyclical stock, so it does sort of reflect the market. And in the last 3 or 4 months, we have seen good growth like back.
Well, that decline was 2 years worth. So it wasn't just that incident at all. It was going that direction in the first place. So that something had to be happening in those prior years. I mean, were their sales going down, earnings going down?
People just expected a bigger boom due to COVID.
Yes.
And so when a bunch of people invested at, I believe in 2020, increasing the stock, making it jump up. I thought we did have a closing prices, and it basically, if you take out 2020 to 2022, it's been roughly increasing. It's just that boom from COVID and everyone shopping at Target because it was one of the only places.
Thank you.
So what happened in 2022? And I'm mentally, my math's a little slow because you see a big jump in PE. It kind of as an outlier, right? And the ROE goes down. And so you saw a big drop in EPS. So what was the driver of that? That was the LGBT thing?
That was just a part of it, like Hunter said as well. The market's been a little wobbly from 2020 to 2022.
I think it was excess inventories. So coming out of COVID, a lot of these retailers.
I was trying to remember what it was.
Saddled
I
with,
thought that
they got saddled with excess inventories and that had huge
places
lots
to
of
open, so.
Yeah.
I also believe that retail theft played a large role. I think, I don't know if Dick's Sporting Goods is a direct competitor of Target, but their stock took a hit as long as other retailers such as Home Depot, I believe Walmart did as well. So I think from when it bottomed out at 110, they did have a Q4 earnings that beat expectations, which brought it back up to around 160. But in turn, the market also did rebound as well, being that Target is a cyclical stock.
Omni-channel was the buzzword you're looking for.
Wow, I don't need to change.
So
That a movie channel?
the question about the value proposition, you talked about consumers being within 75 miles of a store, comparing that to it. So theoretically, they should be able to deliver on a more cost-effective basis by having how many retail outlets versus how many prime fulfillment centers? Do you know that? How many Target stores are?
Oh, how many Target stores is, so. Do we know the exact store count?
It's roughly around 2,000 total stores, I believe, in the US. And I know they're dedicating to build 300 in the next couple of years, I believe.
Yes,
So the percentage is gonna increase further.
So using those 2,000 stores as your fulfillment centers allows you to deliver more efficiently to 75% of Americans that live within 10 miles compared to wherever the nearest Amazon fulfillment center is.
Exactly.
Yep.
Can you run to the ratios, slide? I don't know.
Yeah.
This one or the?
Yeah. So you guys, I was confused by the debt to equity statement. Because you said 1.5 versus 73, 45, and 31. Help me with that.
So the debt to equity ratio, it's supposed to be 158. When we're working through it, we ended up updating it to 158, but it looks like our changes just weren't saved, so that's why it's at 158 or 1.58, sorry. So that's just a talk.
So that's the ratio compared to the actual percentage for Walmart, Costco, and then the industry.
I think I got you. I'm just a little confused. So it's 158
versus 73 or
Versus
1.58.
It's higher than Walmart.
Okay, so it should be 158.0 versus,
Correct.
okay.
Yes.
sorry, when you said that, you were talking about, I said, that doesn't make any sense to me. And then that leads me to just a general comment. You guys, slow down a bit. Just slow down. You guys whip through stuff fairly quickly. And with all the numbers on the page, it just takes a little bit longer from our seats to kind of absorb it all, especially when you make comments like that. And then I'm looking at that, I'm like, okay, I'm totally lost. And then I think about it for the next 5 minutes, I lose half of what you said after that. So, just general comment later in life.
We confuse easily.
Yeah, we've confused very easily.
Speaking of that,
Yeah.
can you go, like, maybe slide 23 or 24, you talked about the free cash flow method of valuation. Educate me, it seemed to me to be a big difference between the EPS and the free cash flow valuations.
So I think what it was is that when we were calculating it, we used value lines estimations, as well as the fact that we believe that Target's gonna invest more into their capital spending to grow, as Hunter mentioned, for their 300 additional stores. So when they're investing more back into the company, their free cash flows are going to suffer as a result. And that's why we chose to do 90 at the PE, because our average values for the baseline bear and bull were just too low, and didn't even for the bull case, was exactly a little bit less than what Target bottomed out in I believe last year in 2023.
Got it? Okay, go ahead.
No,
Okay, I'm gonna ask an unfair question. So in your research, did you find any, certain industries have certain valuation metrics that investors kind of key in on? For example, financials, banks, price to book is typically a valuation method that they use compared more probably than PE. When you're doing your research, did you notice as you're reading and learning about the company, were there any specific metrics that they seem to use in retail that maybe would work better from a valuation perspective than, in this case, free cash flow, where you could have substituted that? It's a fair unfair question, because I know that's part of the assignment. But long term, what I'm thinking is, and kind of a comment for you too, is it seems to me over the course of the last 50 years that we've been doing this, 51 for Bob, not a lot of weight has been assigned to free cash flow. It always seems to kind of go towards PE. So is it, if that's what students are using, is that even a relevant metric to be using, or should it be part of their assignment? Like, look, hey, certain stocks have different things, like price to sale seems to be the hot thing within tech. So you start to incorporate whatever is unique to that industry. Should that be used as an alternative to free cash flow? I mean, still understand free cash flow, because as dividend payers, free cash flow is very important. So going back to my original question, I only got a minute left, maybe it's homework. Are there other metrics that you guys looked into that you thought were useful to evaluate a retail company like Target?
I think definitely the return on assets is probably our key one, just because of the amount of inventory that goes in and goes out of the company each and every day, whether that's through a fulfillment center or the actual store. That we have a trailing 12-month number of around 7 compared to 10 for Costco. So Costco is a little bit better at getting that return on their assets being a retail company, whereas we do exceed that for Walmart. And do you guys know any other metrics other than those? No.
Just curious. Good.
All right, I think we're out of time. Good work, guys.
All right, so for this year's UWO Corporate Spellman Fund, we are recommending the stock Amazon. I'm Carter. With me today is Ethan, TJ, Burke, and Simon. So today we'll be talking about Amazon's business overview, revenue breakdown, and then looking into the risks, financials, and key growth drivers. Then we'll present our valuation and how it fits within the portfolio, as well as our recommendation, and finally our summary. So as you know, Amazon was founded in 1994 by Jeff Bezos and is now a global corporation that offers a diverse range of products and services. Amazon is guided by 4 principles: customer obsession rather than competitor focus, passion for innovation, commitment to operational excellence, and long-term thinking. Amazon generates its revenue primarily through its e-commerce platform, which is through the sale of goods, subscriptions, and third-party sellers. And Amazon Web Services, also known as AWS, which is the company's cloud computing division. Amazon has a 38% market share in the e-commerce industry with a market cap of 1.8 trillion. And Amazon's third-party seller services saw a 27% average growth rate over the last 5 years, with their revenue totaling roughly 140 billion in 2023. Amazon also has a market share of 31% in the cloud computing industry and is the current industry leader. AWS saw a 29% average growth over the last 5 years and is expecting continued strong revenue acceleration from factors like backlog conversion and increasing demand for AI products. So today we are recommending a buy of 50 shares of Amazon stock at a price of $9,200. This is based off the current price of $184. This will give us a target return of about 7.5% from our target price of $198. So some of Amazon's business key aspects is their strong brand recognition, product diversity, and distribution network. Some challenges are their dependence on third-party sellers and data security, and their opportunities is market expansion as well as AI integration. The key drivers are AWS and third-party sellers, and some risks are intense competition, regulatory concerns, cybersecurity, and possible AI bubble.
Here we have Amazon's price history from January of 2021 up until current. And as you can see, our trailing 12-month PE ratio is around 51. Our ROE is around 20, and our EPS is around 3.5. And as you can see in 2022, Amazon does not have a PE ratio, and that is due to their negative net income in that year, also a negative ROE and EPS. And here we take a look at some of Amazon's revenue streams. Their biggest revenue stream is online stores, and online stores makes up roughly 40% of revenue. And they've averaged a 4% growth for the past five years. Third-party sellers makes up roughly 24% of revenue, and they've averaged 27% growth for the past 5 years. Subscription services make up 8% of revenue with a 27% 5-year growth average. AWS makes up 16% of revenue with a 29% 5-year growth average. And then the other category, which includes shipping services, advertising, and healthcare, makes up roughly 11% of revenue with an 18% 5-year growth. Here we show kind of the revenue history and growth rates with Amazon. As you can see in 2022, AWS as well as the other category were the largest in terms of growth. And in the other category, this is partly due to their acquisition of One Medical, which is their entrance into the healthcare industry. Here we have revenue stream breakdown to the pie charts. As you can see, online stores, third-party seller services, and AWS makes up the majority of revenue. In 2023, online stores made up roughly $232 billion of revenue. Third-party sellers made roughly $140 billion, and AWS made around $91 billion. Take a look at ESG. Some of the pros we found with ESG was packaging waste reduction. And then Amazon has also pledged net zero emissions by 2040. They've also planned to increase hire of military veterans as well as increase their investment in the community. Some cons we found were they have a lot of high energy consumption as well as record of poor worker safety and labor practices, and then a lack of diverse board members. So overall, we rate this company slightly unfavorable based on ESG. However, future outlooks look promising. As Amazon is the world's largest corporate purchaser of renewable energy. They've also planned to increase their fleet of electric delivery vehicles, and they're expediting responses to feedback to enhance work environments. Here's a risk matrix we made up with Amazon. One of our higher and more probable risks is worker layoffs. They have been cutting jobs in order to increase efficiency and lower costs. Another high risk we found was the AI bubble. As you know, the AI industry is still fairly new. So the future outlook is filled with a lot of uncertainty. And then some other notable risks we found were government regulations, competition, and data breaches.
Taking a look at their financials here, I first want to turn your attention to the PE ratio. So the PE ratio is a little high for Amazon, but we feel that the profit that the company can generate doesn't effectively capture their market return. So therefore, we recommend using the PEG ratio to evaluate that because it factors in the growth of the company. As TJ mentioned before, in 2022, Amazon did have a tough year, and that's for a couple of reasons here. The first one being coming off the pandemic, a lot of consumers were ordering a lot of brick and mortar products directly to their home, things like toilet paper, furniture, laundry detergent. And then as the economy reopened, those people went back out into the real world and were able to purchase those products in person. Another reason 2022 was kind of a tough year for Amazon is due to the war in Ukraine. They saw a lot of supply chain disruptions, which made it difficult to ship their products directly to their consumers in a fast and efficient manner. And finally, in 2022, the CEO admitted that they kind of hired some workers and also had too many distribution centers built to keep up with the demand that was from 2020. And so they decided to shut those down and kind of lay off some workers in order to catch up with those. And then looking at their debt here, Amazon currently has about $79 billion in debt, $8.5 billion of which is coming due here in 2024. And their debt is currently completely offset by cash that they have on hand. And then this is just the chart breaking down their debt for the next 5 years. All of it is almost for Amazon. There is just one segment that's for Whole Foods, just coming in at 126 million.
Looking at Amazon Web Services, AWS is the cloud computing arm of Amazon that provides on-demand computing and storage resources over the internet with pay-as-you-go pricing. Currently, the cloud computing market is estimated to get to a value of about 0.68 trillion in the year of 2024. It's projected to reach a value of about 1.44 trillion by 2029, with a compound annual growth rate of about 16.5%. AWS's mission is to drive efficiency, innovation, and cost savings for businesses of all sizes. As mentioned before, AWS accounted for roughly 16% of Amazon's revenue in 2023. Looking further into this, in their most recent quarterly earnings report, we saw that AWS actually accounted for 62% of Amazon's operating income. It has a very large profit margin, and as businesses increasingly migrate to the cloud, AWS continues to expand its global footprint and service offerings. For our baseline model for AWS, use a starting growth rate of 15%, which is actually fairly conservative, varying it year to year, ending with a growth rate of about 26% in the year of 2027. We're expecting companies to need cloud computing services for cost efficiency, storage, computational power, and flexibility, especially as businesses continue to integrate AI and expand their need for these services. Looking back over the past couple of years, AWS's revenue grew by about 46% from the years of 2021 to 2023. Going further, for our pessimistic projections, this is assuming that cloud computing services could possibly be affected by an AI bubble and the market as a whole is overvalued. It also assumes that AWS can possibly loses market share to Microsoft and Google's products, which as we saw in Q4, AWS had a 13% growth rate compared to Microsoft and Google, which grew at 30% and 26% respectively. In these projections, we use a starting growth rate of about 13%, varying year over year. For our optimistic projection, this is assuming that the AI industry continues to expand, and there's a cycle of revenue between the AI industry and cloud computing as businesses continue to integrate. Also assuming the cloud computing industry continues to grow at the rate that we're expecting. And in these projections, we use a starting growth rate of about 20%, varying year over year.
So just jumping into the third-party seller services that Amazon holds, there are basically two different subscription programs that people can have. They can either have an individual or professional. For the individual, it is about $1 for every item that is sold. And then for the professional, it's $40 per month with no limit on how many items they can sell. And on top of the subscription service, they have to pay a referral fee, which can range anywhere from 8 to 45%, depending on the product category. Amazon really covers all their bases. They have over 30 product categories. And then if the product does come up with a referral fee of less than 30% or less than 30 cents, sorry, they end up having to pay just a base 30 cents fee. And then basically why we see this as a growth driver is just because the independent sellers face significant growth once they get their products on Amazon. I'm sure, as we all know, you can find almost everything on Amazon from multiple different distributors. In fact, in 2022, the independent sellers sold over 4 billion products within the Amazon web store. And then seeing that growth from 2022 to 2023, Amazon's third-party seller services saw a growth of 20%. So we decided to put a growth for 2024 of 20% and varied it year to year, maxing out at 25% in 2027. Now getting into the pessimistic scenario, this is just assuming that these independent sellers are fed up with Amazon, as the lowest price has to be on Amazon. So if there's a sale within their website, they also put the sale on Amazon on top of paying that referral fee. And then for the optimistic scenario, we assumed that Amazon would like to keep growing at a rapid pace and then bring in more third-party sellers. So possibly changing that rule of having the lowest price on Amazon so that companies can put a sale on their own website, but then mark the price how they want it on the Amazon web store. So breaking down the valuation a little bit, this is just our projected EPS numbers. We found the AWS and third-party seller services EPS by multiplying their revenue streams that TJ mentioned before by the 2023 net profit margin, and then dividing that by the shares outstanding. And then the other EPS just combines the everything else beyond my web stores, healthcare, subscription services, and the event services. And this is our pessimistic and optimistic EPS scenarios. So we basically just assumed that for the pessimistic scenario, everything was gonna go poorly for Amazon. So we dropped the net profit margin, we dropped the growth rates, everything like that. And then we did the opposite for the optimistic, assuming that as Amazon grows, it just continues to get bigger and bigger. And breaking down our individual methods here for our 1-year outlook. As you can see, the PE method showed to be favorable for the baseline and pessimistic. However, the free cash flow was more favorable for the optimistic. So we opted for an 80-20 weight for PE and free cash flow for the baseline and pessimistic, and then just flipped that for the optimistic scenario. So 20% for the PE and then 80% for the free cash flows.
Looking at the portfolio fit of Amazon into the Spellman fund, you see the Spellman fund currently holds about 4.7% in the consumer cyclical sector, while the S&P currently holds about 10.5%. Amazon's overall correlation with the fund is 0.6, which is actually a better correlation than about half the stocks in the fund. We do see they have a high correlation with other tech giants in the fund, such as Netflix, Microsoft, and Apple. Overall, why we feel it's a strong fit for the fund is that it would bring up the fund's allocation in the consumer cyclical sector, while also providing it with, while also helping it maintain its position in the technology sector as well. And as Amazon gets into healthcare and communication services, needs to grow more and more, this could also benefit the fund. To summarize, Amazon is one of the world's largest companies with a market cap nearing $2 trillion. Despite this, they have one of the largest growth potentials of any company, with third-party selling accounting for 24% of their revenue and being the leading cloud provider with a 31% market share. Despite their high PE ratio, we believe their PEG suggests its price is more justifiable than it might seem. And Amazon continues to hold a strong share in the e-commerce and cloud computing markets while maintaining a strong global presence. For these reasons, we're recommending a buy of 50 shares, totaling roughly $9,000 at a purchase price of about $185 a share. Thank you. Opening the floor to any questions.
Okay, you're up. Fine.
Well, thanks.
You're so nice. Can you go back to the PE versus the free cash flow methodology and walk us through? It's at the end.
It's way
And just walk through again your philosophy and what you decided to do and why. I think this, what you guys described, is unique. I don't think I've heard this setup before. Not saying it's wrong or bad, but I'd like to know more about it. So let's start there.
Yeah, so the reason that we chose basically different for the baseline of pessimistic is just because for the optimistic, as you can see for the PE, the target price was about like 206, but for the free cash flow it was 216. So we would still show a return with the PE method. We just think it would be a better return for the free cash flow, which is why we weighted that differently, basically.
Okay, so you're basically optimizing for the highest prices in your target.
Yeah.
In your moving the numbers around to do that. Why? I guess, I mean, the easy question is why? Why do you think that is a intellectually honest way of doing it? And I'm throwing that out there as a big word that could be need more coffee, but it's just interesting that you guys are optimizing for the highest price and why you think that is justifiable, I guess. I don't know how else to explain it. Maybe somebody could fill in with better words. You understand what I'm trying to say?
You're curve fitting. You're trying
Exactly.
to skew it.
Yeah. Thank you. You're so nice.
For one thing I will say is that the PE ratio has been historically very high. So there hasn't been a lot of fluctuation with that, and with a company like Amazon, usually a high PE can be scary because that's usually more tailored towards newer companies. So I think our thought process was that the PE being less of a factor into what their profits would be.
Just a formatting thing. The dollar signs should probably be on the earnings and on the price, not on the PE ratio. So that confused me right up front. So just kind of stylistically on the top of the box there. You kind of made a good point there. What growth rate were you using? Because you keep referencing the PEG ratio at 120. Were you using a growth rate of like 40% to come up with that number?
It was based on the, so for back to the financial slide, the future PEG was based on our projections for the EPS growth.
Page 8.
Yeah, I think I have page 8 on there too for questions.
Yeah, so this one, the future is based on our projections for growth. And then for the past growth, that is based on their basically past EPS growth rates. So we saw basically higher growth obviously in the past than we have projected.
So what's the growth rate when you go from negative to a positive number?
Yeah, it's quite large.
Infinity or something? So I question that a little bit. You're right to look at the PEG ratio for this. I don't know that 1.2 is the right number. 1.63 is probably more in line using your projections. But then if I'm doing that as a comp, are you comparing 1.2 to 1.6 or 1.6 to 1.6 when you compare it to Microsoft? What do you think is a fair comparison?
Yeah. So I feel like where I messed up in this is that I believe that I use, so for the trailing 10 months, I used the past 4 quarters basically. And since that didn't encompass the 2022, I think that's where the difference does come from. And then comparing obviously to our projections, where I probably should have used, kept it similar, kept like used like the yearly for the trailing 12 months growth rate, obviously for the EPS. In this scenario, I would say we should compare the 1.6 and 1.6 for the future and Microsoft, just because that shows our projections, basically we're basing our evaluation on.
In that same vein, current growth rate, you said around 20, and then you said it varies in your projections out to 2027 is up 25%. I typically think of as growth rates slowing over time. You know, it's easier to go from $1 to $2, that's a double, than it is to go from $1 billion to $2 billion, which is also a double. But it sounds like you have an accelerating growth projection, or at least the next 3 years. Where are we in the cycle for Amazon? Are we still a new company? Are we a maturing company? Did you account for the different segments? Walk me through your growth rate.
Yeah.
The growth rate you're using over the next few years.
Are we speaking on like our growth drivers or just like as a whole?
As a whole. So I don't know if are we still thinking of Amazon as a new company?
I think.
And we have accelerating growth, or is this?
It's almost hard to like describe Amazon, or at least their online sales portion, I'd probably describe as a maturing company, but their third-party seller and cloud computing arms, I'd say is more of like a new like addition to Amazon, at least AWS. As I mentioned before, AWS made up about 62% of Amazon's total operating income as far as their last quarterly earnings report, which came out like 3 or 4 days ago. So we're expecting, at least for the accelerated growth for AWS and cloud computing to be like very strong for at least the next 3 years. And as we've seen from a lot of these large companies, they're investing a ton of money into these AI startups, which in turn kind of gets kicked back to them as they need cloud computing to expand their AI models. And as they have larger and larger AI models, they have larger and larger needs for cloud computing. And it seems almost every business is trying to dip their hand in AI, like improving efficiency in their business. So at least that's the reason for AWS having such strong growth rates. Third-party sellers, I mean, they've just seen historically great returns on their third-party seller service over the last couple of years. And I think we just kind of expect that to continue, especially if they modify their terms to benefit third-party sellers even more, and give them a reason not to leave Amazon and keep using the Amazon web store.
The third-party sellers, does that get run through a fulfillment center, or are those third-party sellers then shipping direct to end consumers?
They use Amazon's distribution.
You go through Amazon distribution system.
I actually work at Amazon's distribution center too.
Can you speak about that? Is one of the questions.
How are the workers' conditions?
Yeah. What are the?
I actually have a camera in the van that like tracks what I do. Like if I don't have my seatbelt on, or if I do like a rolling stop or something, there's like a literal voice in the camera. It's like connected to AI, and it'll like say something to me, like point deduction, like safety hazard or something like that. I mean, the conditions really aren't that bad, but as far as like, as we said in their ESG, like how they're trying to expedite their response to like worker safety concerns, like I definitely see that working there. Like every day I get there, I have to take some sort of like safety survey, like what do you feel we're not doing well enough? Like what are we doing on this front? So that's kind of, it was just kind of interesting to like be analyzing the company while also working at the company over the semester. I don't know. I do kind of see some of these like improvements they're talking about here, like actually working on the job.
Could you go to your breakdown of EPS by the different growth drivers? You had mentioned, someone had mentioned 62% operating income coming from AWS. And when I look at this, I look at the EPS you're attributing to AWS, I'm not getting to a similar number. So walk me through how I should be thinking about the operating profit. AWS is more than half of the overall company operating profit, but you're showing EPS of not close to that.
I actually wasn't the one that calculated this, but those numbers we only found as recently as like 3 or 4 days ago, and we haven't been able to find a like reliable net profit margin for AWS online. I was able to find on their latest earnings report of 37% operating margin based on their percentage of net sales for AWS, but none of these companies have released like an actual, this is our net profit margin for our cloud computing arm, which is why we weren't able to really include those numbers in our EPS projections as far as I'm aware. If Simon can expand on that as well if he has anything to say.
I mean, basically, we never really found any sort of, this is the profit margin for AWS for like their different revenue streams. So we just clumped it all in as a whole and used the company's whole net profit margin for both of the drivers and then the other.
So for 2023, which I'm assuming is historical, how did you determine that AWS is 47 cents of EPS?
We just based that off of the net profit margin of 5.3%, just because we couldn't find the.
It's 47% of $2.90.
It's 47 cents of
$2.90. Yeah. So how did you determine? I guess I'm not following.
Just we basically multiplied the AWS revenue stream by the 5.3%, and then divided that by
reported revenue.
Okay. I get it.
So if you did 37%, you'd have had a higher number, but they couldn't find a reliable.
Yeah, I understand why you did it that way. But given that AWS is such a larger profit margin business compared to some of their others, you end up with numbers that it's hard to justify that those would actually be what those numbers are, even though you couldn't find the numbers.
We felt that was just a better idea than just trying to fudge the numbers based on what we could find online that doesn't really actually represent their profit margin. I mean, we did find the operating margin, but that was as close as we got.
fudging those numbers might have got your free cash flow number more in line with. Because you have higher operating profits at a faster growing segment, then as you look forward, those free cash flows are gonna be a little stronger. You probably discount those back and find it's more in line with the PE calculations. And then you're not curve fitting as much as you are telling the story.
Damned if you do, damned if you don't.
Pete, can you go to slide 8 for me and just tell me what I'm looking at here?
Yeah, that was weird too.
I always think of line graphs as going left to right. But this line graph appears to not really be showing trends, but rather showing growth rates relative to the bars below them.
Yep.
Am I thinking that right?
Yeah.
Might try to find a different way to show that. It's at a quick glance,
We
I
probably
have
could
no
have,
idea what I'm looking at.
the bars are like revenue breakdowns and the purple and yellow lines are growth rates for each of those revenue streams.
Yep.
We probably could have made that into 2 graphs.
Yeah, it's trying to, it's all good data, all information we want. Don't know if I would present it that way. And don't use Vikings colors. Yeah, we're-
I think I got it now. I was confused as hell when I first.
Yeah,
Cause I was
I'll show
looking
you
at,
my
I was
notes.
looking at the right hand side, looking at the growth rates, and I'm
Yeah.
like,
The other is really confusing because in 2022.
Yeah, that's- I got it.
They acquired the One Medical and it almost doubled their revenue for that other category.
all right. Casey, you're an industry practitioner. With a company like Amazon, you were, and it used to be.
the company got smart and said,
On page, well, it doesn't matter, page 24. You're talking about how this fits into the portfolio and you're talking about it as a consumer cyclical, as a tech company, as. What? I like that, I think you're right, but what bucket does it get dumped into for this portfolio? Cause I think Morningstar is gonna sign into something.
I think it just goes,
Morningstar is wacky. So if you look at gig sectors, it's gonna be,
Communications,
it's gonna be, yeah, internet retail, but I think it's in this. Oh, I think it's in discretionary.
Yeah.
I think it's in discretionary.
I think on Morningstar it was listed as a consumer cyclical.
Well, yeah.
Facts, I think gigs is discretionary. So
So it might be fun to dump it into this to see what it actually looks like post, but it's a very unique company in that regard.
we have to put
Because
it,
you don't really have
you
that
have to
with
put it in a
these.
bucket because the fact that it is a retail company. Started as a retail company, it's turning into a tech company. So I actually liked you, to his point, I liked your, if I was following it correctly, and I probably wasn't. That's my fault, not yours. Your description of, okay, well, it's got all these different pieces, so it helps here, it helps there. Which is how I used to do this kind of stuff.
Yeah,
Cause I would look at a company and say, okay, try to find another example.
it was Alan
An
Hamilton.
industry, yeah, like an industrial that had tech exposure. It was like hiding in because of the gig sector. It might not necessarily be, in this case, a discretionary 100%, but it gave me exposure to other areas that I wanted to be involved with. Like, let's say I couldn't own a Microsoft or a Google and I wanted some cloud exposure where I could buy an Amazon and it would give me that. So I can make these kind of stealthy plays.
That is part of the reason why we really like Amazon, because like not only is it like this huge retail business, but it also gives you some exposure to like all that AI growth and cloud computing growth that a lot of these like companies are trying to capitalize on. It's like almost like less risky than going for like an Nvidia or something, but like it still gives you some exposure to like this AI industry that's booming right now.
And I think that's kind of the whole point we're trying to drive home here too, is that Amazon is such a large and diverse company that as it continues to grow and expand into so many different sectors and areas, the chances of the downfall of Amazon are just not that high. So we definitely encourage it.
Let me push back on that. If it's got a higher correlation with Microsoft, Netflix, Apple, let's call it the Mag 7, and I think that's what the kids are calling it these days.
Oh, yeah, the big drivers.
Yeah, so let's say all those names, all the investors roll out of them. I mean, it's a momentum market, right? So I'll push back on you just a little bit. Just hit sell.
Question associated with that or?
Just push it back. Oh, it's gonna be a long 12 hours.
It is in the discretionary gigs.
All right, good afternoon, everybody. I'm Zach.
I'm Nathan, I'm Jake.
I'm Clayton.
And I'm Leo. And today we're gonna talk to you about Nvidia. So today we're gonna go over Nvidia, a little bit of their business overview. We're gonna break down their revenue, and then we're gonna go into their financials. We're gonna talk a little bit about their two main drivers, which are their data centers and gaming GPUs. Then we're gonna dive into their risks, and from those risks, we're gonna talk about their valuation. Then we're gonna talk about their portfolio fit into the Spellman fund, and just give a general wrap up of our key points. So a little bit about Nvidia. So they are an industry leading stock with really positive financials and a strong growth future. They have a 95% market share in the data center industry and an 80% market share in the GPU sector. Nvidia currently makes up 5% of the S&P 500 and is the third largest holding in the index. We are projecting a 37% growth in the AI industry until 2030. And their partnerships and market share create such an economic moat for their competitors. It is hard to see that their market share is going to go anywhere anytime soon. So a little bit, we are recommending a buy of Nvidia of 13 shares or about 2.5% of the Spellman fund. We are estimating a target price of $952 and a target return of around 12.5%. So a little bit about their business. They have seen great revenue in the last couple of years because of the AI boom. We've all heard about this, especially with ChatGPT, that really kickstarted Nvidia's growth. They have the extreme expansion overseas, and that is one of their opportunities where they can gain even more revenue. Some key drivers, again, are their data centers and gaming GPUs. And a couple of risks are government regulation, some AI industry speculation, as it is a relatively new industry, and supply and demand problems. So looking at their closing prices over the last year, you can see some extreme upward momentum and growth that has happened. They went from about 275 all the way up and peaked at 975, and are currently sitting around 850 as of market close yesterday. A couple notable ratios are their PE at 71, their ROE at 70, and their EPS at 12. So a little bit about the AI industry. According to Grandview Research, we are expecting a 37% annual growth until the year 2030. And the applications of AI affect every industry on the planet. They lower the cost of operating and increase margins, which is why you see so many businesses switching to it. They are faster, more accurate, and can be 24/7 applicable compared to humans. Little graph down here shows we're about a $200 million or billion-dollar industry, and by 2030, we're expected to be about 1.8 trillion. So some extreme growth.
So now looking at their revenue streams, starting out with data centers. Data centers make up about 84% of Nvidia's revenue with a growth rate of 28%. And then next is gaming with 13% of their revenue with a growth rate of 20%. Following that, they have professional visualization that makes up 2% of the revenue and automotive with 1% of revenue. So now looking into ESG, we evaluated this with both pros and cons. Starting out with the pros, energy efficiency. This is important as Nvidia is designing more energy efficient chips to address concerns with high energy usage. Second, we have renewable energy. So this is Nvidia sourcing their operations with renewable energy by proving this by purchasing renewable energy certificates. And then finally, supply chain sustainability. So this is minimizing environmental degradation and promoting ethical labor practices. Then diving into the cons, the social impact of technology, specifically AI. There are unknown implications of what the future will hold for society with AI. And then next we have complexity and compliance. So that's data privacy and job displacement. And then lastly, environmental impact. So this is again, the high energy usage of which Nvidia is already addressing by designing more efficient energy chips. But overall, we rate Nvidia favorable in terms of ESG.
Taking a look at their financials,
This is their past 3 years of financials along with their trailing 12-month. We decided to compare them to AMD and Intel as we thought they were close to them in the industry. A couple things I'd like to highlight is their ROE is at 70%, their ROA is at 45%, and their net profit margin is at 56%, which is well above industry average and their competitors.
Looking at their debt structure, their debt to equity ratio is about 53%. Majority of the capital structure is either in cash or short-term investments. Their median effective interest rate for the past 4 years is about 2%, and their total interest expense for 2024 was $257 million. The only debt they have coming due in 2024 would be their short-term debt with a value of $1.25 billion. Put this in a little bit of perspective, the revenue for 2023 was about $61 billion, and they have $26 billion in cash on hand. Because of this high cash reserve, as well as the amount of revenue that they had in 2023, we think that their debt structure is very healthy for Nvidia. They can pay off their debt when it comes due next year, as well as if they need to come out with new research and development, they can pay for it in cash on hand rather than take out another loan and take out more debt with the high debt or with the high interest rates that we have currently.
So with data centers taking up over 80% of Nvidia's overall revenue, it's important to understand what even are data centers. Basically, there are these huge infrastructures that are composed of pure computing power. They serve 5 major functions. First being AI and machine learning, which we've been seeing that boom of that over the past year or two. Then high performance computing, data processing and analytics, graphics rendering, as well as cloud services. Jumping into the data center industry, as Zach was saying, Nvidia has a 95% market share in the data center space. So any company that wants to integrate AI into their systems and technology, they almost have to go through Nvidia. And then a little more background of the ChatGPT and AI boom. As soon as ChatGPT was released in November of 2022, that's when we saw that huge climb of the Nvidia stock price and really introduced the world to this AI boom. Now, who consumes these data centers now? Well, it's the biggest tech companies in the world, Microsoft, Meta, AWS, Google. It's ironic because they're all competing against each other to implement AI. They all have to go through Nvidia and partnering up with Nvidia to really make these implementations. Now, looking at how we determined the data center growth rate out until 2028, we looked at the 5 functions of the data centers and created a weighted average where we weighted the AI and machine learning at 50%. And the other 4 at 12.5%, mainly due to all these other 4 functions that's not the AI and machine learning all have AI integrated within it. So as AI grows, the others should grow and backpack off of that growth. So we have an overall growth rate of 28.5% for the data center growth rate. Then looking at a scenario analysis, for the pessimistic and optimistic scenario, we raised it up and down 20%. Where in the pessimistic scenario, we could see some government regulation bring it down, as well as in the optimistic scenario, we could see Nvidia release a new GPU that just blows estimates out of the water, just as we saw in their last earnings call, that could be likely to see. And then if that were to happen, Nvidia's earnings are likely to soar and then blow past expectations.
So moving on to their second highest driver of revenue, that would be their gaming GPUs. Nvidia has an 80% market share in this space, and they actually created this space in 1999, inventing the GPU. A little overview of what exactly a GPU is. If you think anything visualization on a computer, a GPU is responsible for that. That would either be video games, animation, visual modeling. Bitcoin mining ended up being a big factor in their GPUs in 2020. They had a boom during COVID during a lot of people were playing video games, they were staying inside, and also VR technology had taken large leaps and became more viable to consumers. And as I mentioned, crypto mining became very, very popular, especially over in China, which is something that Nvidia actually worked against. They saw their consumers either in America or abroad who wanted to use their cards for video games couldn't because their supply was so low due to cryptocurrency mining that they actually nerfed their own products to make it less effective in cryptocurrency mining so their consumers could get their hands on a card and their prices would come down. So with their baseline growth, we expect a 20% growth rate in their graphics card spectrum. It's been their most consistent product throughout each new generation since they introduced it. And it's been very stable ever since they introduced it. Each year we tend to see Each year, we tend to see consistent growth throughout their gaming sector, as we can see going into the future. And then going through our scenario analysis, for optimistic and pessimistic, we expect either a 10% growth or 10% decline in their growth rate. This is because they have a large competitor being AMD, who's coming at them every single year trying to either undercut them in price or overcut them in performance, which is something that they've been struggling to do. But with the new series of GPUs that's coming out for Nvidia, they're expecting higher prices, their top end GPU being $2,200. That would be the 5090. But for optimistic scenario, we expect this 50 series GPU to be very, very successful, because there's new games coming out that are becoming even more demanding at computers, and the consumer needs these better computer parts from Nvidia to be able to run them. So even though there's gonna be higher performance demands, Nvidia's new series of GPUs is gonna have about a 1/3 increase in performance. And we expect that consumers are gonna have to buy Nvidia, since they are the market leader in performance, to keep up with these new games.
Looking at some of the risks that we've already highlighted, one of the major ones being government regulation on chips. We saw this in 2022 when the government placed a tariff on chips going to China. This affected AMD and Nvidia because they didn't want their highest processing chips going to them. And then we touched on competitors stealing data center market share. Since they have 95% of the market share, we realized that there's going to be a lot of competitors trying to take some of that away from them.
So now looking at annual projected sales for Nvidia. So from 2023, we have 60.6 billion sales for Nvidia, and that jumps to 198 billion by 2028. A big takeaway here is, again, we see both data center and gaming driving most of that growth.
And for the EPS growth, it's pretty straightforward, just as the revenue streams. The data centers and gaming GPUs do take up most of the EPS, and it's looking to grow around 26-27% till 2028. And then looking into the EPS scenario analysis, compared to the baseline, the pessimistic and optimistic scenarios do differ about 5%. And then after 2028, we projected an 8% terminal growth rate, which we do think is quite conservative due to the fact that out until 2028, we have it at 26% growth rate. Moving on to our valuation, we weighted the PE method at 65% and the discounted cash flow method at 35%. For our baseline, we had $950. For our pessimistic, we had $775. And our optimistic came in at $1,260. The current price as of market close yesterday was $850. For the portfolio fit, we saw that they correlated fairly highly with other tech companies such as Microsoft, and they correlated low with health companies like CVS. The Spellman fund's currently a little bit underweight in the technology sector by about 2.8%. And we think adding Nvidia to the portfolio would be a great way for the Spellman fund to invest in AI technology.
Kind of just touching on some main points that we had today. Nvidia is an industry leader in both the data center and gaming sectors. We are expecting about a 37% increase in AI growth year over year until about 2030. We think this is a great fit for the Spellman fund, as Spellman fund currently has very little to do with AI, and we think this is going to be a huge industry in the future, and it's a great time to get in. As mentioned earlier, Nvidia currently makes up 5% of the total S&P, so we think it's a great way to come even closer in correlation with the S&P and value investing. And again, Nvidia's expansive and lucrative partnerships create such an economic moat for their competitors to jump over to get into this industry. It's very hard to see their huge market shares going anywhere anytime soon. And again, we are recommending a buy of about 13 shares of Nvidia, which is around 2.5% of the Spellman fund, with a target price of $952 and a target return of about 12.5%. Any questions?
You go to slide 22. I think this is my favorite way of seeing the baseline pessimistic, optimistic. You know, we always see the tables and it's broken down that way, but I like that we kind of see the difference in the projections here. I was questioning your 27% growth rate over the next 5 years. And I'm not sure whether I'm questioning that more or the significant drop off. So maybe that offsets it, because that seems awfully optimistic and we were talking about the bubble the last time and it was, oh yeah, we can totally continue to grow at 28% into perpetuity. And then all of a sudden the bottom falls out. What are the risks here? At some point,
Are you talking like industry wide or for Nvidia?
I'm talking, well, a little bit of both. The big risk to me for Nvidia is somebody invents a better mousetrap. And when you're 90% or 80% market share, there's a big target on your back. But, to me, a pessimistic view would be, even a sharper decline in this. So I guess, going back to that, you probably account for it with the big drop from year 5 to your terminal growth rate. But, to me, that 27% for the next 5 years seems a little aggressive. And maybe you comment on some of the risks to that 27% number.
So I guess a major risk, you mentioned somebody inventing a better mousetrap. We find that extremely unlikely solely because the amount of R&D it takes to develop a current chip. I believe it was over $10 billion for Nvidia's latest Blackwell chip that they just released. So you need to have amazing capital to get that. And with Nvidia's partnerships and with Microsoft, AWS, Google, they're getting all this funding and investments in order to develop these chips. And like we said, they also have $26 billion cash on hand, which can go straight into R&D if needed. They're very liquid as a company. So we don't think that's very a reasonable risk solely because they are the innovators. They invented this technology and they already are ahead of their time in this. A biggest risk for us would be government regulation on what AI can do. So that's probably our highest risk, because if government starts putting limits on what AI is capable of, or like we mentioned earlier with China and the tariffs, that's gonna just extremely lower their growth rate solely because they can't access these other markets. So really, they're only a US based company. Like most of their sales are in the US. So expanding abroad is only gonna further those growth rates to possibly even higher than that 27%. So we think that the biggest threat to our baseline growth is that government regulation on where we can send the chips or where Nvidia or what the chips can actually do. So
When the Intel Pentium 2 processor came out, nobody could touch it. They were so far ahead of everybody. Intel's a dinosaur now. At what point does Nvidia, somebody's gonna come up with something. So I'm careful, I'd be careful about, we don't think anybody could touch these guys because nobody thought anybody could touch Intel, and they only kept AMD around to avoid antitrust legislation. At some point, there's going to be a competitor. Someone's gonna figure this out. So I'd be careful on that one. I mean, my son owns this. I sold it way too early. Maybe I'm just trying to get it down to a different level so I can buy it.
it is, if we go back, it is interesting to point out. So they are very well partnered with Taiwan Semiconductors. That's their main manufacturer. So if we look back at here, so right here, you can see this was a low for the year, 762. So what happened there is TSM actually released a lower than what was expected AI out forecast. However, the reason it shot back up is because both Intel and Apple actually blew TSM's projections out of the water. So now people are feeding back into it, kind of trusting more of the Intel and Apple's forecast rather than TSM.
I got a multi-point question, kind of along what you just mentioned. So obviously they're growing revenues substantially. Did you look into their units growth, like the number of chips that they've actually sold?
Oh, are you talking specific numbers?
Yeah, and I guess my question is, they're reliant on Taiwan Semiconductor, as many semiconductor manufacturers are. What's the supply constraint? Are they able to meet the demand in the actual development, or are they going to be able to grow their revenues through price increases by having that kind of monopoly market share?
I hang on to that quickly because I want to follow up on that, because I think they are sold out the next couple of years. You guys can.
Yes.
So that's one of the things I wanted to, so
So,
bring that extra.
yeah, so one of the reasons we think they're keeping such a large on-hand cash amount right now is because they are looking for that, I believe it was Taiwan, they're actually looking to invest into a manufacturing plant for themselves because so many people want their chips because they are genuinely that good that they have such a supply problem in the, post R&D. So we think that in the future, we wouldn't, be surprised to see Nvidia purchased a huge manufacturing plant over in Taiwan because of that, in order to keep up with demand, which if they're forecasting, like you mentioned, they're sold out. If they're able to start ramping up production even more and get more product out, that's only gonna make the growth rate go up. So, yeah.
On a similar note, you had that, I forget if it was a charter table that was showing the revenue dollars over the next 5 years, and I think it was like 190 billion, there we go. 198 billion in sales, 166 coming from data centers. Then you mentioned the big four kind of as their main, who they're supplying to. Have you looked into the capacity of the CapEx budgets of those companies on if they can actually get to that large of a number?
Not looked at their funding. We just know currently, so kind of as like a frame of reference, so these numbers may seem high. However, you look at FactSet value line, these are actually conservative. So we're actually down about, I believe, 20 billion in total sales projected. As far as capacity of other companies, no, we haven't really looked into that. However, there's so much money being poured into the AI industry currently that everyone's trying to take that risk to get that advantage. And as they pour more and more money into it, their systems are going to be more reliant on that AI. So they're going to have no choice but to invest more to keep all their systems up to date.
Thank you.
Can you jump to page 7, please? I was a little confused. I've been confused all day. Nope, not this one. See, I'm confused.
What part are you looking at?
It was the one where you had all the various growth rates and you compared them to what the industry average was or something.
Oh.
Just different one, different table. Oh, wait, go back, sorry. Nope, another one.
Is that an evaluation? It might be the data
Not
set.
that one.
Where you did your weighted average.
Yeah, you did your weighted average.
More, Jake?
It's back in tracker 1.
Sorry.
Right.
Okay.
Yeah.
So help me here. So you have your average, so you have 50% weight, and then you have 100% growth rate. On the bottom. Yeah, explain that bottom line to me.
Well, that was just the weight. That just showed that the weight is 100% of it. And then like the growth rate, I guess we could have framed that a little better. Growth rate's 28.
Cause I just looked at my eyes went to those last 2 numbers
Yeah.
and it totally confused me. I knew you were adding up that weight, but the growth rates didn't make sense to me, so.
So this was definitely like
Explain this to me.
Yeah, this was definitely like our largest challenge, I'd say, because like with AI being such a new industry and the forecasts are just all over the place, really projecting where Nvidia's data centers are gonna go is just like trouble for us. So the best way we could put it into like tangible terms was breaking it down into the 5 functions that the data centers actually do, got the industry growth rates for each, and then we considered weighting it equally. However, the growth rates just did not really make sense compared to like the past and the future projections. And when looking into the high performance computing, data processing, graphics rendering, and cloud services, AI is integrated within all of those. So it was difficult for us to really pinpoint exactly how the weight would work. But with that AI growth at 37%, we figured that all these other functions would backpack off of that and really drive the growth. And even that 28.5%, it's still relatively conservative relative to other FactSet and other analysts. If you look at, I guess like we looked at like FactSet last night, and our EPS for next year, ours is projected to be around 21, and analysts on there, the average is around 25, just for reference. So
I think I got it now. I just, when you guys put it up there, I was looking at all these numbers and then half listening, trying to figure everything out, and then I think I got it now. So basically, the punchline is for your data center growth, you're using a weighted average growth rate of 28.
Exactly. Yes.
Okay, sorry. I was just looking at,
yeah,
when I first looked at it, I thought it was something growth there, and then I was looking at the industry growth and I'm like,
Yeah, I get you.
It's been a long day. Then, just as more of a question, so when you made your final kind of pitch, you made the point that can you remake, there's a couple points you guys made at your final pitch about how Nvidia would be great for this. It'd be a good fit for the Spellman Fund. Can you just recycle that really quickly?
So are you talking like just in general?
Yeah, in general.
Yeah, so we think it's a great fit for the Spellman Fund because we currently have no AI in the Spellman Fund. The closest one would be the Intel, but as he mentioned, it's kind of falling off. And with that huge market share Nvidia does have, we believe that people are going to be looking to Nvidia and have that, they're going to have that future growth. So we believe this is the new standard for the industry. And also, it does make up 5% of the S&P. And, you know, with that value investing, we believe now is a great time to get in. And we are also underweight in technology. The Spellman Fund is 2.7%, I believe, in accordance with the S&P. So.
First, you hit the exact point that I wanted to make. Be very careful when you say there's very little exposure to AI. Apple, Microsoft, Meta, and Google, which I think we could probably argue has some AI exposure, that's 11.6% of the strategy. If you include AMAT, who's also making chips and all that, what else did I put here? Qualcomm, Intel,
JP Morgan is financing all those companies.
Yeah, no. There's a slippery slope that you could go down.
Well, so I guess.
So I got 25% if you include, not even including like SAP, which is gonna tell you that they do AI as well. So be careful when you make very broad statements, definitive broad statements like that, because people can pull holes out of that. That's-
And I thought you were going a different direction. Nvidia is 5% of the S&P yearly, so if we invest in Nvidia, we'll be closer to the S&P. We don't want to be close to the S&P. We want to beat the S&P. Is this going to be? Do we want to be overweight, underweight this relative to that? So that's how I would think of it in that context.
Yeah, I can add on, well, I guess that kind of just shows the growth S&P's had over the year, like over this past year, and Nvidia's been the main driver in that growth. So, and with them sticking with that 5%, we do think this is just an absolute great asset for the fund. Great, a lot of growth.
So a lot of times with these, and this Nvidia becomes a challenge. What we wrestle with a little bit here is you try to come up, what's the addressable market? And going from there. And you think of the data center piece, and you go, well, how much data is already in these data? And so, well, you can always come up with another data, right? You can always expand on it, or where you don't think there's data, all of a sudden there's more data because now you're driving a car and it's measuring all these things, and that's all. In those projections, did you see anything that kind of said at some point we're gonna get to that peak data center where, okay, we're not adding new data centers on a net basis or something like that?
So kind of going off that, yes, you need the data centers to store the data. However, once the data is there, it can't just sit there. So in order to access that data, you need something to process and, you know, understand what is stored in that data center. So that's where Nvidia comes in with their GPUs and their AI chips. That is what processes that data. So yes, you can always get to that limit of, you know, what percentage of the world that is stored. However, you're constantly going to need something that understands what that data is and that can put it into understandable English for people to understand. So no matter how much data is already captured in those data centers, something's always going to have to be understanding, reading, and remaking that data into packets so everything understands it around it. And there's always going to be the need for faster and more accurate data.
Yeah, and adding on to that, since like the data centers do compute all this AI technology and do all the computing for that, the growth is supposed to hit a AI market cap of like almost 2 trillion by 2030. So it's just supposed to grow immensely, and it's hard to even visualize what the world is going to look like as it's going to get implemented into literally every industry. Like as we were saying, or as you guys were saying about like it's already implemented within Microsoft, within all these companies. Yeah, all these companies are implementing AI, but who's actually running the AI in the background? It's mainly Nvidia's chips or Nvidia's data centers.
And kind of piggybacking off that a little bit. So obviously they have these data centers in place, but we've all known stuff sometimes breaks. So you're gonna have constant upkeep on these data centers and constantly gonna have to get new chips, constantly gonna wanna expand for if they get more data and if they wanna up their capacity, they're gonna be able to upgrade constantly. So that's also another interesting thing to take into account is the maintenance on these data centers as well.
What is the obsolescence cycle in this? So at what point do you, okay, you're on version 1, we just released version 4. When version 5 comes out, we're gonna stop supporting this. So I guess how often, what's the turnover? How often do these need to be replaced?
So Nvidia actually doesn't like, unlike Apple, who kind of like leans out of their old models, Nvidia doesn't. You can use that processing, the GPU until it's burnt out. Unless the only reason most companies upgrade from like a 1 series to like a 40 series for the upcoming 50 is because they need more just pure power. Yeah.
Kind of backing off of that, something that Nvidia GPUs can do that I think AMD does as well, but I think they use for these data centers. It's not necessarily they can only have one generation, they have to replace the whole thing. They can continue to add new cards as they get more efficient, more powerful, and they can start to take out the old ones as they replace them with new ones. So it's just kind of I guess, a versatile structure that they use where they can continuously cycle, and it doesn't have to be a massive investment where they take out all the 10 series cards and replace it with 50 series cards. More gradual than that.
Are we worried about China, Taiwan, and their dependence on that part of the world for manufacturing tensions?
I don't think we're really about Taiwan more specifically. They're also looking into Singapore is also another possible manufacturing plant. We would prefer obviously Singapore just with the Taiwan, China, tensions. So we do think Singapore would be the best option. However, I know, with that $26 billion cash on hand, they could very well, go wherever they wanted, and I'm sure our country would be happy to take them.
Intel just made a very large investment in America, so it's possible that Nvidia wants to do the same thing.
So got a minute. Can you run back to your free cash flow EPS chart where you kind of get your price target in your ultimate suggestion? No, the one at the end with the
For the true valuation.
your valuation, and it comes up with your actual price target. And I just had a real quick question. Okay. Current price. So your recommendation is, remind me.
We want to buy.
Okay, and at what price?
So as of market close yesterday, it was $8.50. Currently, you look at it actually after Apple's earnings, they had really good AI. So I believe they're actually closed at around $8.87. We can actually foresee that such volatility in the market right now. We could recommend a limit buy with, say, a structure to purchase 5 shares at $8.50. And, as it progresses, you could add more into the fund. However, we would warrant caution because Nvidia's first Q1 earnings are at the end of May. And we predict they're going to blow it out of the water, which is only going to skyrocket their price above, we think, $1,000, just because of market hype with the AI industry. That's why we are currently just saying an overall buy because of that future earnings. And, there is always that risk that they miss the earnings. However, looking at their year-over-year growth and just quarter-over-quarter, we don't foresee that happening.
The reason I'm asking is because I know these are way outdated, but I wanted to know kind of what your thought process is around the limit by 800.
Yeah.
And you had that there.
Yeah.
And then why 800? I don't know what the price was at the time that you decided that, but
Yeah.
as you're thinking about limit buys, why? What's the methodology behind it?
So I guess $8.50 is kind of what we settled on because that seems to be the price it's kind of hovering around. 3-4 weeks ago, like I pointed out on that chart, it did dip below 762. We wish we could have presented then. That would have been awesome. Unfortunately, it doesn't work out like that.
You might have been freaked out. You don't know what, see, the thing is, you don't know what you would have been thinking at that time because you would have said.
We're pretty confident. But so yeah, that's where the limit buy comes in, just because the volatility.